Good morning.
Yeah, exactly.
I'm calling the Board of Investment meeting to order. Today being Wednesday, September 14th. It is 8:30 in the morning. Before we proceed, we'll ask Linda to provide a few announcements, please.
Thank you. The meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Knox? Thank you. Mr. Green?
Here.
Thank you. Mr. Kehoe?
Present.
Good morning.
Good morning.
Miss Greenwood? Mr. Jones?
Here.
Good morning. Mrs. Jones? Good morning.
Here.
Mr. Kelly? Ms. Sanchez? And Chair Santos.
Present.
Okay, we may proceed with the agenda.
Thank you very much. So we moving forward to opening remarks. I would like to start number one. Welcome everyone. Appreciate everybody being here on time. But I'm going to use the chair's privilege and ask Vivian Gray to make it a quick announcement.
Good morning, everyone. I just would like to invite you all to the SACRS Fall Conference, which is going to be held here. It will be the best times are November 10th and 11th, which is Wednesday and Thursday. I have often asked everyone to attend because SACRS programs, the agenda is all very investment related. As opposed to Board of Retirement related, and I'm on the Board of Retirement, you would think I would do something for us. But I invite you all to attend. Registration is open now. SACRS is the State Association of California Retirement Systems, which includes the 20 pension funds that are under CERL, the California Employees Retirement Law. So I hope that all of you would attend. I would also highlight the fact that our own John Grable will be leading a panel of CIOs there as one of our agenda items. And I hope you all will attend. And it's open not only to trustees, but staff especially, and our consultants and everyone else involved. You are all invited. Thank you.
Thank you, Vivian. At this point, I called Mr. Grable for opening remarks.
Good morning, Mr. Chair. Good morning, trustees, colleagues, members of the public, people on Zoom. It's great to be here. It's once again great to be in person. I thought yesterday was a fantastic day. And my big takeaway is how much that we get by being in person and how terrific it is. Hopefully that's not my ring making noise. How terrific it is to get immediate feedback. And as opposed to a Zoom where you just click off and then you go and you think about it. Yesterday, we were able to discuss the various sessions and the fact that there was non-uniform opinions expressed, which is fantastic. But then we were able to continue those conversations, over coffee at dinner. And I look forward to more of those conversations today.
Thank you, Mr. Grable. I think I agree with you. I think it's very important for us to be able to mingle, exchange ideas. That's how we learn. Linda?
I forgot to call on Ms. Ginsburg again 2 days in a row, so I want to make sure that everyone knows she's here. So I'm sorry, Ms. Ginsburg.
The record will
The record reflect that she is here for the second day.
Thank you very much. Next item on the agenda is public comment. I know yesterday we had public comment. Thank you, Linda. I believe you sent, or somebody sent copies of the remarks made in public comment. So the record should also reflect that. But today there's no request for public comment. So moving forward, real estate opportunities, Mr. Agrabah.
Good morning, Mr. Chair, trustees, esteemed guests, consultants, and LACERA staff. The first session will commence with a discussion on the megatrends that will help shape the future of real estate. Before we dive into the presentation, I'd like to give a brief overview of the real estate program. I will then introduce the first speaker. Okay, if you look at the pie chart on the left-hand side, it shows LACERA by property type. And if you look at the pie chart on the right-hand side, it's Odyssey. Odyssey stands for Open Diversified Core Equity, which is LACERA's benchmark for real estate investing. So if you look at the pie chart again on the left-hand side, and if you look at the bottom portion, you will see that LACERA's real estate program is overweight both industrial as well as apartments. And you'll also notice that LACERA's real estate program is underweight retail and office. These are all intentional over and underweights, and these were presented to the board in the structure review earlier this year, and we're in compliance with those. Moving on to the next slide. Sorry, I'm going to go back one slide. Okay, in this slide, you'll notice that the first pie chart on the left-hand side shows LACERA's investments by geography, and the pie chart on the right shows LACERA's investments by geography, but just in the United States. So going back to the first pie chart, which is the one on the left-hand side, you'll notice that LACERA is concentrated in the US. Almost 85% of the investments are in the United States, and 12% are in Europe and Asia, and then up to 3.6% or 3% are invested globally. And if you look at the pie chart on the right-hand side, you'll notice that we have a concentrate on the West at almost 40%. Moving on to the next slide. We are now morphing away from what historically we used to invest through separate accounts and more into commingled funds in the real estate side. So going forward, we'll be investing through commingled funds. And now I'd like to introduce our first speaker for today. It is Mary Ludkin from Heitman. Mary Ludkin is a veteran in the real estate space. She was previously the chair of Pension Real Estate Association, also known as PREA. She is currently the chair of the Urban Land Institute's Randall Lewis Center for Sustainability in Real Estate. And now, without any further ado, I'd like to welcome Mary to the podium. Thank you.
Let's see if this works. Can you hear me if my laptop is in this position? Maybe I can do it. There we go. Hopefully I can still read it. As Amit noted, I'm a veteran. It is with great fondness that I returned to Long Beach. I've been here multiple times, but this is the site of my first market study, the first time I flew in a plane for work. In March of 1990, little realizing California was about to head into a really long recession, but one I learned a great deal from, and some of those insights are reflected in my comments today. It is truly an honor to be here. And kudos to you all for selecting this particular topic, which allows us to look beyond an immensely complex current time of high inflation, rapidly rising interest rates with more to come, and the recession risk rising by the minute. We can jump over that for the morning and think 5 to 7 years out, real estate, looking ahead, real estate in 2028 is the title that I put on it. I'm going to cover several themes in the next 30 minutes. And Chris, you've asked me to try to be spicy. I will try to be spicy as a researcher can be. The first relates to something that was evident in your portfolio already, which is the takedown of two stalwarts in institutional portfolios from the dawn of time. Uh-oh, can we back up 2 slides? And did I do that? Oh, good. Amit, don't do it. Whoops. How about I cue you when it's time? Do you mind? Thank you. All right. So the first relates to this diminishing role for office and retail in the real estate portfolio. I'll talk more about why they were there in the beginning and why there's less of them now. Another theme relates to what should fill the gap created by the diminishment of office and retail as part of your portfolio and that of institutional investors broadly. My third involves globalization, which has been a driving force in economic growth and in the low inflation that we enjoyed for 40 years. That era has ended. Deglobalization was underway prior to COVID, but a pandemic and an increasingly fraught geopolitical environment with a shooting war, goodness, that backdrop has diminished the risks of, it's heightened the risks of reliance on partners that may or may not be able to or want to be reliable in this environment. When I was asked to speak on this topic, the first thing that came to mind was demographics, because demographics are one thing you can look at 5 years out with some clarity as to what you're likely going to get 5 to 7 years in the future. One of the most predictable aspects of looking ahead. We've got two giant trends underway that will shape the real estate investment environment over the next 5 to 7 years. First of them, the aging of the global population. We'll see how long I get on this bad knee before I crave sitting in that chair. And the preferences of the gigantic millennial generation, as they now represent the dominant group in the working age population within the developed world. Eldest millennials, just to keep you going, eldest millennials are turning 40 this year. And there's a cohort of them in the US, in Europe, and in Asia Pacific. And then finally, climate change, which presents both risks and opportunities to real estate investors. Next page. One final opening comment before I get to what's on this screen, but you can look at it while I'm talking. 5 to 7 years from now, the shadow of inflation will rest on those making investment decisions and constructing portfolios. By then, we'll have insights about how real estate and inflation have performed that are much richer than those that we have from the early 1980s, which is the last time we all saw, or some of us saw, inflation like this. But real estate as an institutional asset class was in its infancy. So the lessons from them are not particularly applicable. What we think is going to happen, what I expect will happen, is that real estate will perform during this period of high inflation relatively well, particularly for those sectors where supply and demand is in balance during this time, and where sectors have short lease terms, as they provide a more efficient inflation hedge, as they allow for a quick adjustment to higher prices. Think self-storage, think apartments with their one-year leases as short lease term sectors. This will mean that real estate will remain in demand by institutions and by retail investors alike. Don't move. In the early days of institutional real estate investment, investors often tried to match their long-term liabilities with assets like retail and office that had long duration leases. Often those leases had rent steps on an annual basis that were tied to CPI. Secular trends, though, have eroded the performance of these sectors. Retail in general, but particularly regional malls, which we used to own in abundance in institutional portfolios, they have lost market share to e-commerce. Meanwhile, office was suffering from several dynamics that were negative pre-COVID, including the sheer cost of keeping these assets full, with capital expenditure reserves representing 28% of the net operating income of office buildings in the NCREIF index. The highest among sectors, 28% of your NOI had to be reserved for the new roof, the new lobby, the tenant improvement costs, how to bring in new tenants. After strong performance in the 1980s, office has lagged among sectors due to these high CapEx drags, among other dynamics. Pre-COVID, alternative sectors, such as those shown at the bottom half of this page, were gaining traction. 5 to 7 years from now, they will, we predict, represent an even greater share of institutional portfolios for good reasons. Medical office shown in the bottom left, it's largely a US sector, but with some investable opportunities in Germany and in Australia. It fits the slow but steady wins the race bill. It's small in size relative to commercial office buildings, but it often has credit tenants, which is what you're trying to get often when you're investing in much larger commercial office buildings. As a result, you can create a diversified portfolio. You can buy 4 assets with the amount of money that it would take to buy a downtown office building, for example. Their net operating income isn't prone to the wild swings that commercial office buildings experience, helped by demand that's driven by demographics and a supply side in which speculative construction, the idea of beginning an office building without pre-leasing, that doesn't happen in the medical office world, and that keeps supply and demand in balance. Meanwhile, self-storage on the bottom right, it is not much to look like. There's no granite or marble on its facade, but its cash flows have proved to be much more durable than those of commercial office, for example. So doesn't look like much, but it has earned its way into institutional portfolios. It is not recession proof. A recession hits, husband and wife look at one another and say, do you even know what we're paying $150 a month to keep in storage? They don't know. They go to the storage locker, they clean it out. That reduces occupancy. That's happened recession after recession. But by contrast with other sectors that get vacant during recessions and stay vacant for a long time, self-storage has demand drivers that continue even during recessions or are perhaps heightened by them, including military deployments, downsizing, relocation within a metro area or across metro areas. All of those often involve putting something into storage. And as a result, while it does indeed show some volatility during recessions, self-storage has shown league-leading performance over the past 25 years, and it has strong prospects ahead. Next slide, please. We're anticipating that sector rotation, which is already underway, is going to continue, and that will shape the landscape 5 to 7 years out. Current institutional portfolio weights by property types were the theme of Amit's comments. I'm showing you a slightly different version of them. On the left side of your slide, I'm organizing who owns what by property type within the institutional realm. In Europe, that's the far left column on the left side of the chart. Asia Pacific is in the middle, and then North America, which is really the US, is on the right side of the left part of the chart. How's that for confusing? What you can see is that office in the United States, as of last year, represented 27% of the total, retail at 12%. That is down from a decade prior when office was 39% of institutional portfolios and retail was 25%. But like LACERA, there's been a sell-off in both of those property types. What has been replacing it is industrial and residential and increasingly specialty or alternative property types, which as of last year in the United States represented 6% of supply, a small but growing share in both Europe and in Asia. The right side of the chart is investor intentions as conveyed to a group called NREV in a survey of 89 institutional investors. Look at the far right-hand column. You can see only 9% of investment was targeted at office. I can't even tell you how much is for retail in purple. Call it 2%. Industrial significant, residential significant, and look at that growth in the demand for the specialty property types like life sciences, like medical office, storage, senior housing, student housing, even manufactured housing parks. Next slide, please. I'm going to talk a little thematically about where we work and how that creates demand or lessens demand for certain property types. Big changes are afoot globally in how and where we work. Work from home was underway pre-COVID, but COVID accelerated this trend like putting jet fuel in a normal engine. 4% of all office workers in the US were remote in 2019. 26% were full-time remote as of year-end 2021. Work from home and what most of us are doing, which is hybrid work, part in, part out, lots of time on Zoom calls. It's possible due to a collision of technology that enables work to be done mostly from anywhere, demographic dynamics, and corporate decisions like the embrace of the open plan office, which is generally hated and rarely achieves the collaboration it's meant to spark. In fact, studies have actually shown it reduces interaction. That's Nick Bloom pre-COVID, Stanford University. You may have seen David Brooks's piece in the New York Times last week entitled "The Immortal Awfulness of Open Plan Workplaces." Is that spicy enough, Chris? It's as spicy as researchers are going to get. It's important to note the office is not dead. It will and is remain an important element in how work gets done. My husband's a geographer who studies the office market, and he says the office building is the repository of those functions not yet automated. It's supposed to be a place for us to think and a place for that thinking to get communicated. Open plan offices have worked against that. But I do believe that there will be many CEOs, many already are, calling their employees back to the office. Not particularly successfully in many instances, but by 5 to 7 years out, there will be clarity around this. I think as some of those Gen Zers that are thinking they can just do it from their room are going to realize that the path of career advancement might involve access to people that can teach them something, access to their colleagues, and their social life might be enhanced by those workplace friends. Next slide, please. It's important to note there's considerable variability in who works where around the globe and regionally, and this affects who works from home and who doesn't. Work from home, much more likely in settings with large homes. It's less likely in cultures and companies where FaceTime is important. Lots of people like it, particularly if they have a setup that allows for quiet work and the kid to not walk in the middle of your conference call. Work from home is often liked in settings like LA, where it replaces a long commute, or in New York, where it replaces not a long commute in the car, but a long commute on transit, which has been seen as a vector of transmission in the COVID era, right or wrong. 5 years out, we're going to know a lot more about this and what employers have decided and what employees have decided about where they're going to work. What we do know is this has created great risk for the office sector as a whole, as if it needed more risk, and there will be definitely permanent destruction in the demand for office. Where office is working right now is brand new buildings that have COVID era ventilation systems, often have places to be outside and working or close to outside and working, and places that are in live, work, play districts, as opposed to the monocultural places like LaSalle Street in downtown Chicago, our former financial district that now has a higher vacancy rate than at any time in my life, both for the upper floor office and the ground floor retail. That's an opportunity, more to come on that. But as I will reiterate, office remains a risky bet. We'll have a lot more clarity 5 to 7 years out, but I doubt that you're going to be increasing your allocation to office. But even if your plan includes no office investments in the LACERA portfolio, you need to be mindful of where people work as it affects residential locational decisions, and residential is going to form a large and increasingly large weight in your portfolio. Next slide. Empty or underutilized office space will represent a giant investment opportunity, but it's one that has to be approached selectively, as not all settings where office is vacant will be settings that make themselves ripe for alternative use. This is not an untested strategy. In the US, federal historic preservation tax credits led to massive amounts of adaptive reuse of early skyscrapers in the late 1970s, up to the tax rewrite that some of you might remember from 1986. Since then, individual cities like New York City and Calgary have used property tax cuts, tax increment financing, and other forms of stimulus to spark conversions. Calgary right now has a grant program. They will give you up to $20,000 to, or I believe it's $20 million to renovate one of their dead office buildings in their dead downtown. In Europe and Asia, where there's much more focus than in the US on the energy used and the emissions generated to build existing structures, it's standard practice to reuse buildings, but pick your spots. And here I will quote my colleague Zubair Mahbub from London, our London office. Canary Wharf's a soulless island full of Blade Runner skyscrapers with few connections and fewer amenities. Hard to see who would want to live on the 55th floor of the HSBC Tower on an isolated peninsula with little shopping and no social life. Next slide. Moving away from office, a diminishing element of institutional portfolios to industrial, a recent star and one of growing importance, a trend we expect to continue. This chart shows the progression of this sector from volatile, macro-dependent, prone to hard times during recessions to portfolio stalwart. Industrial demand shown here in blue, supplies in red, and the nexus of the two is the vacancy rate. That's in the gold line. What you can see if you look in the left-hand middle of the chart is during prior recessions, when industrial production was more the driver of industrial demand, hard times descended on this sector. But if you look just to the left of the dotted line on the right side of the chart, you'll see that this is a sector in which demand has outstripped supply in 10 of the last 12 years. And that includes the COVID recessionary period when demand slowed but didn't go negative. E-commerce sparked this remarkable run in the US, but in recent years, deglobalization has been a significant contributor as reshoring of manufacturing created an estimated 350,000 jobs in the US in 2022 alone, with more to come. Reworking of supply chains will continue to drive demand even as e-commerce build-outs slip in the US. The forecast, as you can see on the right, not Heitman's, this is that from CoStar, it predicts some waning of the demand side, but so long as supply stays in check, this is a sector that will remain strong and provide good risk-adjusted returns. Logistics has been a strong performer in Europe and Asia, particularly in settings like South Korea and Tokyo, where modern distribution centers were lacking and are still lacking. Next slide, please. Migration. Following people has been a reliable investment strategy for real estate investors since the dawn of time. In the US, this has involved following urbanization, then suburbanization, then some re-urbanization. In Europe, urbanization started centuries ago, but opportunities there in recent years have been created by bringing new residential uses to their cities. This includes purpose-built student housing to capture a wave of foreign students wanting to study, particularly in English-speaking locations like London, Oxford, and Brighton. And building modern rental housing in places where rent regulations have constrained supply, like Amsterdam, Berlin, and Manchester. In Asia, urbanization has been an investable theme for decades as globalization and the rise of manufacturing helped spark the move from rural to urban in China, in Korea, in Taiwan, and Vietnam. Next slide. As my headline here shows, we see urbanization as remaining an investable trend with some nuances. First, many of the globe's developed nations are seeing population decline at the national level. This includes Germany and Japan. The US is not immune, with our recent population numbers, census numbers showing population growth at its lowest level ever due to COVID and a lack of immigration. This means figuring out within country migration patterns is essential. In Japan, Tokyo and Osaka are ever more important, seeing population growth even as smaller cities and rural areas lose population. The same dynamic is true in Germany. We invest in the big five markets there because they're seeing population growth, even as smaller locations are seeing population loss. In the US and in Australia, both are still growing, but demographics here will shape migration patterns 5 years out. Focus on affordable cities with high quality of life, like Raleigh-Durham, as the giant millennial generation, as I mentioned, the eldest of whom are 40, are in their prime nesting stage of life. The large cities are more expensive. They're going to have a harder time holding on to millennials. They'll lose them to the suburbs. They'll lose them to rapidly growing places like Austin, Nashville, and Raleigh-Durham. That will create its own opportunities a decade out, but for the moment, I would focus the next 5 to 7 years on these rapidly growing alternative locations. Next slide. You knew I was going to talk about climate change. I'm not going to talk about ESG. Happy to take questions about that lightning rod of a topic. What I'm talking about here is the relevance of climate change to the health of your real estate portfolio. Climate change could undermine previous sure things, like migration to coastal areas in the South and Southeastern United States. While hotter conditions and rising seas have already triggered climate migration in areas on or near the equator, Jakarta, the capital of Indonesia, is being moved to higher ground. The trend in the US has been toward beautiful but vulnerable locations, seacoasts, particularly in states offering lower taxes than my home of Illinois and your home of California, and places in the space between urban and wild. While we're not urging investments in Buffalo and Duluth right now, they're positioning themselves as climate winners, abundant fresh water, climate that's going to get warmer and therefore more bearable. We are capping our portfolio exposure to places vulnerable to hurricanes and typhoons, to drought, to wildfires, to floods. We're also watching carefully the burgeoning realm of required reporting on climate risk exposure and the regulation of emissions from buildings. That image on the bottom right-hand chart for your investments in London, need to know this is the UK's energy performance regulation 7-point scale. If you own a building that doesn't get rated under their procedures in the top 3 categories, circa 2026, you can't rent it out. That will create opportunities. It's clearly creating risk. Next slide. Migration will and is accompanying the rapid aging of the developed countries of the world. It's part of the strong demand for housing in the US Sunbelt, in Spain, and in Australia's Gold Coast, all investable opportunities. Senior housing, whether it's for active adults or for those with greater needs for care, is an investable strategy broadly. Developers have been building for this eventuality, the rising of my generation into its dotage, for decades. But just a caution that they've often gotten ahead of the trend in the US, leading to overbuilding of senior housing. For senior housing investment, we either like debt strategies in the US, where somebody's ahead of us in the first loss position, or we like supply constrained settings like Europe. The European senior sector is a particular interest as its stock is filled with obsolete facilities. 1/3 of the stock existing in the UK is double occupancy. You don't come in with a partner, you get one. And half of the German stock involves bathrooms down the hall. Not what I'm going to want in my golden years. Next slide. I'm going to conclude with a couple remarks on portfolio construction, and here you can go to the next slide. This chart, in a not particularly exciting way, sums up our thoughts on portfolio constructions for 5 years out. Thumbs up for residential in its various stripes. That includes a really controversial sector, the single family homes for rent sector, which fills a role both for those that are choosing a lower density setting with a yard in which to rent, or those that are forced to that option when they want to raise a family in a good school district and can't afford to buy. The other category in the middle includes medical office storage, which I've already discussed. It also includes small but rising sectors like data centers and life science, some of which you have exposure to in your portfolio already. Both of these have advantages as their demand drivers don't come from the macroeconomy, but instead come from our need to click, our tendency to click and click again, and for demographic dynamics. Like the aging of the population, as well as the birth of millennial children. Those both stimulate demand for medical office and data and life sciences. Life sciences has some peculiarities that include the fact that it's basically built speculatively, no pre-leasing in place, because when tenants want something, they want it now. And the fact that many of those tenants will fail, because that's just what happens in a sector of innovation. So you need to be buying assets that are definitely releasable. 5 years out, we'll know more about office demand. So it's on the right side, the outside right now. It's in the thumbs down position, as is retail. I would say the same for retail. There will be a lot more clarity in 5 to 7 years in this sector. What's happened in the pandemic was a reinforcement of the role of physical retail for firms like Wayfair and Bonobos that thought they could do everything online or on phone only. They found themselves opening stores as the cost to gain new customers online rose from $100 3 years ago to $800 on average over the last year. With that, and with physical stores being cheap because their rents were so depressed during the COVID era, more stores are being opened by formerly online only stores, and more stores broadly opened last year than closed. Is that a thumbs up for retail? No, because we still have way too much retail. But on occasion, you might find something interesting, particularly as an out of favor sector translates into a high going in yield, which has value in a portfolio. Next slide, and my final slide. I'm going to conclude with a comment to you as a global investor. Part of the rationale for going global is to diversify away exposure to a single country and its economy. The era of deglobalization we've entered should heighten the argument for global portfolios, as there should be greater variability on the macro side. The argument in real estate is that, plus another element, an additional benefit of a global portfolio is the ability to take insights learned in one region and apply them elsewhere. The alternative sector in the US, for instance, is much more institutionalized than elsewhere in the globe. Many of the big storage companies are listed. The 5 top ones are listed, and one of them is in the S&P 500 as an example of institutionalization. As institutional capital flowed into storage and medical office over the past 2 decades, yields have compressed and investors got the benefit from their strong cash flows and yield compression, generating outsized returns. With some nuance, this is playing out in Europe and in Asia, allowing investors to catch this for the first time if they missed it in the US, or to relive it one more time. With that, I will conclude and say that I'd be delighted if there's time to take any questions you might have before Margaret convenes her panel.
Any questions? Sorry.
I just wanted to get your thoughts on this new development of mixed-use properties where you have residential, you have retail in the same facility, as well as even in some cases, medical offices. Let's see, what was the other thing that we're seeing? Oh, retail, residential, and office space.
Yes.
All in one facility.
Yes.
Which previously would have been some large industrial building that we would have sold, but they're repurposing it and creating this mix, almost like a city within a city, because
Yes.
you could get your groceries, you could go to the doctor, all within this one little area. So I just wondered what your thoughts are as far as looking forward to the future with that concept.
It's not completely new in that mixed use high rises were built in major center cities, Water Tower Place in Chicago, there are versions of it, Trump Tower in New York, where mixed use was the thing, even in the 80s. The risk today in these single buildings is that you rarely catch the cycle right for all of the various uses in your property. Where I like it better is where it's compartmentalized and you can parcel out the apartment development of a former regional mall out parcel to somebody that knows how to do that. You can sell your land to them and they bear the risk, for example. And then your return isn't dependent upon all sectors catching the market just right, because that rarely happens. But I do think the bringing of new uses to formerly monoculture areas is an investable theme. Just do it carefully.
I don't see any other questions, but I do have a question. So with regards to retail,
Yes.
I get what's happening in the United States, but then you see other parts of the world, like emerging markets, Latin America,
Yes.
even Asia, where retail continues to grow. Does that represent an opportunity for us? I know at one point we talked about that we were on the way international investing versus the home investing. So what's your view of that?
Thank you, and apologies. It's hard to give a global presentation and talk about every sector on a global basis. So I left retail out, in part because it's really complicated, even when you're just focused on the US, much less going to Europe, to Latin America, to Asia. One thing I would watch is that many non-US locations were slow to pick up on e-commerce, and COVID brought more e-commerce shopping than they had seen in the past. Often credit cards were not available and therefore people weren't buying online, but they got over that barrier in COVID. So there are markets like Australia where e-commerce is grabbing market share today, mimicking what was happening a decade ago in the United States. So I would say tread cautiously and, broadly speaking, focus on those properties that serve daily needs, more grocery anchored centers, places that people have to go to, especially in an era where inflation is making them wonder whether they should pay that $5 for delivery, or shouldn't they just go and pick their avocados out themselves, right? So I would say it varies a lot location to location. Some markets like the UK are woefully overbuilt. That could create some investment opportunities as things are sold at a deep discount, and other places retail demand continues to grow. So I've just said everything out of both sides of my mouth, but I would say don't say no to retail just because of the risks in the US, but know that you need to understand the local story and somebody needs to assess the opportunity and the risk.
And a good consultant.
And a good consultant, well said.
Gina Sanchez.
Hi, one of the things that I've seen is this increasing interest in specialty use
Yes.
buildings. And I'm wondering what the challenge is, because so many of those require such specific retrofits
Yes.
that what's the sort of challenge that the market shifts at the end
Yes.
of whatever the cycle is, and then you're stuck with a medical building that you need to turn into something else.
For sure. And that's part of why medical office trades at a higher yield than other sectors, because of that risk that at the end, you're not serving a medical entity. That's part of the underwriting. You need to do a scenario in which there's the what does it take to remove the build out, and is there another user for it, or are we looking at land cost? So I would suggest a lot of scenarios. It's better to be in a proven location, especially one with strong demographics, especially as medical office has moved, just to use that as an example, it's moved away from being connected physically or adjacent to hospitals, and instead is often embedded in a deep residential market where there's not likely much reuse. For that, we pick dominant practices that look as though they've got a future, but I would not want to understate the risk in plighting your trust to somebody that could indeed, all the doctors could retire in a decade. You just need to underwrite that as part of the initial assessment of opportunity and risk.
Thank you for that. I don't see any other requests to speak. We need to move forward. Thank you very much.
Thank you so
Outstanding
much.
presentation. Thank you.
Thank you, Mary. Now on to the next presentation, which will be a panel discussion on economic growth, demographics, and climate change, and how it'll impact real estate investing in the future. The panel will be moderated by Margaret McKnight. She'll be joined by Bob Perry and Broderick Story. Bob Perry is from CBRE Investment Management, and Broderick Story is from PAG. Margaret McKnight is a partner and head of portfolio solutions at Stepstone. LACERA hired Stepstone as the real estate consultant back in 2021. Before joining Stepstone, Margaret was at Carlisle's Metropolitan Real Estate, where she was co-chief investment officer and fund head of their global fund series. I will now let Margaret introduce the panel. Welcome, Margaret.
Hello, thank you so much. And it is a privilege to be your advisor. I'm going to ask the panel to come up and have a seat, and I'm going to try to figure out how not to get blinded while I talk to you. This is Bob and Brad, who has come a very long way to be with you. Thank you so much. And a huge thanks to Mary for a fabulous introduction. The things that she's talking about are not controversial. We fundamentally agree with nearly everything she said. We are now working with staff to build within your real estate guidelines a much more refined allocations to property types and locations that are very much in line with what Mary just talked about. And then we will be bringing to you over the next couple of years, options to redeploy and deploy capital into these strategies. The art is really picking the managers who in turn will pick the street corners, the cities, the countries, and the property types to actually deploy the program at the lower level in accordance with the targets. So this is a perfect setup for a lot of discussion that's going to come as we bring real estate choices to you. And just a reminder, you have kind of two buckets in your real estate portfolio. The core portfolio is where you're essentially investing in what's already happening in a place. And the non-core portfolio is where you're investing in a strategy to make what's happening in a place better, to really enact change. Real estate houses the economy. So it is very important to understand what's happening with the economy. A strong economy does not guarantee good performance on your real estate portfolio, but it does give you the wind at your back. And when we look around the world, just regionally, by far the strongest growth is coming from Asia, then the US, and then Europe, with those two kind of at a markedly lower growth outlook for the next 5 years or so. And the US and Europe are now grappling with much bigger inflation problems than Asia for a host of reasons. So I chose to focus our discussion on Asia, which Brad is going to address, and the US, which Bob is going to address. I'm happy to take questions on Europe. I'm not writing it off. There is a lot of transition, that not only the slower growth, they have been thrust into a decarbonization that they kind of weren't ready for. There's a lot of transition happening there. Transition does beget opportunity. We are by no means redlining Europe. But I want to talk about the growth stories in Asia to help get you more comfortable as we bring more Asian solutions to you, and also more comfortable with what's happening in the US and what's fundamentally going to be a slowing economy because you have significant deployments in the US. And hopefully the folks around this table will bring us your questions as we go. So we're here as your resource to make sure they do get addressed. With that, I want to start with Brad. And can you talk, Brad runs Asia ex-Japan for PAG, and his firm also has significant activities, very successful. We've been invested with him in Japan, so he can address the whole region. But can you talk about the growth trends in Asia and what's interesting from a real estate perspective?
Well, firstly, I just want to say thank you very much for having me today. It's appreciated. And also, Mary's a hard act to follow, so I'll try and do my best. Look, I think there are a couple of I'll deal with some specific macro trends that I think are worth sharing, and then also looking at it from a fundamental real estate perspective. What you're seeing, and it's interesting, Japan, if you look at the stats, and depending on where you look at it, the IMF, I did a quick bit of research, and the US, for example, is quoting the next 3 years GDP growth at about 1.3%. Japan, which is the weakest economy in the region, is 1.7%. So if you look at it on most metrics across the jurisdictions that constitute Asia, you're seeing significantly greater economic growth, even if you exclude China. And I think that's important because Asia is far more diverse, even though there are some headline economies there, than what it necessarily represents with the name Asia. I think also what we're going to see, and I think as a forward basis, and this goes to looking at those sort of headwinds Mary referred to, something we look at, not headwinds, but backwinds, if you like, is that if you look at demographics and the growth in the middle class, which I think is intrinsically important as you look long term, I think in the next 10 years, they're talking about middle class globally growing by about 1.4 billion. Guess where most of that's coming from? 90% Asia. So that middle class helps grow consumption, investment into real estate, investment into education, investment into medical, services around hospitality, etc. So I think there's some very compelling reasons why Asia on a long-term basis looks attractive. The nuance with Asia is that the execution environment is very different. They are not homogenous markets. It is very, very distinct culturally as you invest across the region. And to be a little bit contrarian, if you like, office, for example, in some markets would be absolutely where I'd invest now because of the nuances that exist in that market, but to Mary's point, in the right location. I think from a real estate perspective, why the markets are getting more attractive, and if you like, some of the thematic risk is reducing, is you are getting increasingly what I call more sophisticated domestic capital bases. For example, you're seeing REIT sectors develop, all these sorts of things that are consistent with mature markets. In some of our markets, they're some of the most sophisticated in the world. Take, for example, Australia. And what we're also seeing is occupier trends, reflecting the change in nature, and it's very different across the region. Retail in Singapore, I'd invest in if you could get it at the right price in the right location, because 60+% of it is going to be about F&B and lifestyle, and they live in their shopping malls. I mean, I don't know how many of you have been to Singapore, but you don't want to be outside a fair time of the year, and it's very concentrated. So I think there are a range of interesting trends there, but it's very different execution-wise, and that some markets do have more risk than other markets. Sorry, that was a bit long-winded, Mary.
Can I push you to get a little more specific?
Oh,
Country-wise?
Country-wise, so I had to make a call, certainly in the short to medium term, and certainly where we're investing. We've done in the first half of this year about 4.4 billion in investment activity. We're investing in Japan, we're investing in Seoul, we're investing in Singapore, Australia and New Zealand for very different reasons. Sector-wise, we're about 51% allocated to data centers, about 24% to renewable energy, and about 25% to office. That's our portfolio, and that's where we're investing on a short, medium-term horizon. Some of that's more thematic. Data centers for us, I think, is very compelling on a long-term basis. Was that specific enough, Mary?
Getting there.
All right.
And the elephant in the room is China.
Waiting for that.
All right. All right. Well, this is recorded, so I will measure my comments. But look, I don't think that's an attractive from a real estate perspective. That's not a market. We've been reducing our exposure for 5 years. We have under 3% allocated to China. In the near term, we're not going to probably invest in China. The real estate fundamentals are not attractive, and some of the constraints that we look for in normal markets don't exist there. It's you've got the intervention or activity levels of SOEs make it very difficult. You don't have supply constraints the same way you do in a lot of other markets. So I think China is very difficult to invest in. It's also going through a period of time where you're seeing the centralization of the economy and some regression in the progress they've previously made. And we need to get through to the end of October and get greater clarity around economic direction as the politics settles down.
Mhm. And yet and still, it's kind of spilling over and creating growth in other countries.
Yeah, absolutely. I mean, we're seeing Singapore, I suspect, is probably going to be the best performing on a relative basis economic environment in the world for the next 12 to 24 months. We're seeing growth in Japan, interestingly, in a very positive way. But to Mary's point, you got to break it down. It's Tokyo and Osaka, particularly from a real estate perspective, where you want to be weighted for from investing in real estate. But in Australia and New Zealand, the environment, we're seeing a liquidity squeeze occurring because you've got the most conservative banking regulator in the region. Liquidity is coming out of the market and there's some genuine mispricing. Now, from our perspective, that's going to create potentially a very interesting opportunity, particularly with inflation impacting markets the way it is. It is a risk, but it's a mitigatable risk. And what it will do is push out supply pipelines. So in some of our markets, we are seeing better than expected rent growth coming through. We are getting rents. I'll give you an example. In Seoul, we're refurbishing an office building. We bought it at about 100 and the passing rent at the time was about 170,000 peon. And what is happening now is we're doing rents at about 240,000 peon before we've done the renovation, which is only 10,000 peon below what we're targeting. So there are some of those dynamics coming out to play. It's not without risk, but there is opportunity with risk. There always is in my experience.
Yeah, it seems like Hong Kong is decamping to Singapore right now. Our office is certainly moving. Thanks. Now I want to switch to the US, which is sort of second highest growth in the world, but not stellar, and definitely slowing with modest longer term growth potentials. How does that affect how you think about where to invest and what to invest in?
Yeah, thank you, Margaret, and thank you everyone for inviting me here. I'll give you my perspective as strictly a US only investor, although a lot of themes that you've just heard are consistent with the US with different regional characteristics. I will say that, as we know, averages can mislead. And so across the US in my career, I've never seen a period of greater bifurcation than today, greater differentiation in terms of returns, either across the region, one city to another, or returns across asset classes. Let's call it retail, office versus apartments and industrial. We heard some of that in Mary's conversation a moment ago. Now that also spells opportunity if we can, again, get ourselves in the position of investing alongside those corridors of growth. And so we talked about some of the sectors that have some positive growth characteristics, sectors like apartments and industrial, and some of the specialty sectors that Mary touched on a moment ago. By the way, we fully believe in all of that. We're investing our programs, both short-term and long-term, against those dynamics as well. But I will say there is dramatic regional variation, and even within region, variation within market. So there was mention earlier of Chicago. And 10 years ago, we might have looked at investing in Chicago, and we might have made the choice, do we invest in Chicago versus the New York City area? Today, we're thinking about not Chicago as a uniform investable universe. We're thinking of West Loop versus Fulton Market. We're thinking of certain suburban markets versus certain very specific micro locations. And I think our industry, particularly in the US, our data capture, our ability to invest intelligently in what I'm considering to be micro drivers of some of these locations is really important. Because in a market, as Margaret mentions, that has growth, but lackluster growth, certainly compared to Asia, we have to be really focused and we have to be really targeted about channeling ourselves in front of those favorable wins. Now, I'll give you a further example. For the last 10 years, basically, if you produced industrial or apartments, almost without respect to location or configuration, you probably won. We were dramatically undersupplied there. We continue to be in most markets. And so our focus is still to develop and to acquire responsive, forward-looking assets of those sorts. However, we think you get an additional tailwind of growth, you get an additional margin of opportunity without an incremental corresponding margin of risk if you're doing it in the right places. Inland Empire still, even at its dramatically low cap rate and dramatically low vacancy, still offers some of the best fundamentals regionally in the market for industrial. New York City, in a way, from a rental point of view on the multifamily side, is one of the top performing markets today, and we think will continue. Now, it belies a certain amount of that affordability argument that we talked about a moment ago. But again, we're not trying to make a property that's affordable for the entire market. We're targeting a very specific owner, user, occupier. And if we've got the right basis, the right asset, and importantly, offering the right management and ultimate end product, there is demand support that's there today, and we think will persist into the future.
So what you're saying is you got to be smarter.
It is a stock picker's universe today in real estate, no question.
100%. The devil's in the details in real estate in a big way, more so than ever. Last year with the Odyssey return over 20%, which is unprecedented long-term returns in the 6 to 8% range. Industrial was over 40%. So, you know, if you could fog a mirror, you could make money in industrial, it's going to get harder. And also your relative portfolio results in a competitive environment were largely determined with such a big differential by your percentage allocation to industrial and on the other end, office and retail. So how quickly and dynamically you can shift to the most interesting products really matters. We have, with these big shifts, we've seen property type really come to the fore in a way that it hadn't before in this industry that was always location, 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 which is not to say location doesn't matter, but what you're doing there is kind of more important than ever. And then an offset, before I ask you about regionalism, I'm going to say there's still globalization in investing. One of the big factors I think that is going to bolster US real estate is that international capital still wants to be here. It's a big, stable, diverse market with positive growth overall. And especially in the core sector, we talked about, when I talked about your core portfolio, I said the relatively more attractive returns are in the US. So that's something we've been busy with, is talking to international investors and who are investing in the US, and that will bolster pricing as we go through kind of what is likely to be a more significant price adjustment in the marketplace. There is a lot of that kind of dry powder sitting on the sidelines waiting for an opportunity. Now, shifting back to fundamentals, how have you seen these trends towards regionalism affect US real estate?
It's been dramatic, and I think it will continue to be dramatic. We're seeing real regional differences, not only in growth patterns, but obviously in migration, out migration, and just in the cost of living. And if we talk about the millennials as being the largest cohort, and we know generally what stage of life they're in or moving into, it's a spending phase, right? They're gathering homes, they're having children, they're paying for schools, and so on and so forth. And you know, the field tilts towards those lower cost, higher quality of life type environments. And so you know, it's what you've heard a little bit before. It's a lot of the Sunbelt markets, a lot of the Smile markets. But here again, even regionally, within a sort of a more traditional core gateway coastal market, there are locations even here locally that you know that your millennial counterparties are moving towards for those same reasons. Those are places, again, on a very, very micro location, targeted, focused way to be looking for investment opportunities. It goes also to sector. There was a moment, there's a comment a moment ago about the single family for rent business. It is a charged business, right? In terms of a new entrant into the residential marketplace that may or may not be contorting values elsewhere, but it is here to stay. And it is a legitimate investable product for some of these exact same reasons, because it provides affordability often in markets that are otherwise unaffordable. So there's a great degree of regional shifting that goes on, that will continue to go on. And it's interesting, even 5 years ago, I heard a lot of discussion about, well, should we be investing in gateway coastal markets or what used to be called secondary markets? We don't hear the word secondary markets anymore. And even in our recent experience of you know, competing for acquisitions in places like Charlotte and Atlanta and Raleigh-Durham and some of these other emerging markets we talked about, we're often competing with capital that's coming directly from overseas. And so these places are on the map, they're noticed, other investors are seeing what we're seeing there in terms of the growth support. And importantly, that makes them quite a bit more liquid. So the previous discussion used to be, well, I will accept a lower return in the gateway markets because there's this element of liquidity. New York is always available for sale. What I tell people is, that may be true, but liquidity is only one half of the equation. It's liquidity at a price. Okay, so yes, 45th and Park Avenue was liquid during December of 2009 for $200 a square foot. Now you paid $1,200 a square foot for that building, so that's probably one of the last places you're going to seek to gain your liquidity. You could if you needed it. So it's liquidity at a price. And I'm here to say that most of those heretofore secondary markets have dramatically improved in their liquidity profile.
Yes, as people have spread out, and that affordability is going to be a very big issue as we go forward. And the residential sector and this is globally. I was just talking to our European team about this morning, but as things get more expensive, the government has more pressure on it to step in and put rental rate caps. And we have those in most of the cities in the US, but it does still become a political issue to be aware of. But there's also a very deep market there for tenants and owners in the affordable sectors because they're very resilient. And as Bob pointed out, people have spread out a little bit more now. So it makes what was once thin markets less thin and makes institutional capital more comfortable going to those places. Before we dig in a little bit more, I have plenty of questions on demographics and we're going to get to climate change. I want to give the people around the table, are there any questions on kind of the bigger picture economic trends and who's doing what where?
I don't see any.
Okay, just checking in. Yeah.
Thank you.
So question, when we talk about demographic demands, I saw from Mary's presentation, the growing component of the single family rental housing kind of segment of it. I live in one of the little coastal cities here, good school district. So I imagine, Redondo kind of fits that profile of people looking for that. But given the crux in affordable housing at, say, maybe the second quartile of income earners, kind of middle income or so, is there not a low risk, high return or moderate return profile that fits that user that you're seeing that's out there? Is everything, or is most of the opportunity that we're pursuing all on that? And you kind of describe a certain user for, I think, in Chicago or what have you, which I'm imagining is probably not a entry level middle market user. I'm just curious, is there an evolving business model that you see that allows for all the private capital that's going into housing, like single family rental housing, that's not creating the perverse effect of excluding a significant part of the population? Just curious from a...
It's actually something we're investigating, to your exact point. I'm not sure that we fully have figured out the mousetrap yet, but you could imagine a set of circumstances where demand is high enough, land is cheap enough. That's a careful balance to try to figure out both of those two things. And maybe a more manufacturer oriented product that doesn't take quite as much time and as much labor, frankly, to build, that you can deliver at a cheaper price point. And I think it can come close to addressing some of the concerns that you're pointing out. We've seen a couple examples of it, and it tends to be on the near edge, the periphery of growing but affordable cities. And the other thing is, depending on the site, you can do certain things in a single family rental context that you wouldn't do in apartment buildings, right? You don't build any stairwells. A lot of times your noise and your fire suppression systems are simpler. And so all of those things reduce costs and reduce rent. So I don't know that it's a replacement for, but there's some space in the middle that those two market segments can be filled in with.
the whole residential sector has been blossoming out because of the affordability issues, because of institutional capital really trying to find stable current yield, which you get from residential, and because of the housing shortages. So 20 years ago, multifamily was owned by high net worth individuals. Now it's owned institutionally. Manufactured housing is making that switch. Single family housing is new. It came up after the GFC when some of the funds bought up, huge numbers of foreclosed homes all over the place and started creating companies to rent those out. The most interesting play today, especially for headline conscious investors, is when a builder builds out a new community, a segment of that new community is homes for rent. And it's build to rent rather than buy to rent. So you can check these cost boxes that Bob is talking about, and you're not competing with individuals to buy homes, but you're servicing those millennials who can't afford to own, but have kids and need room and need better school districts and that sort of thing. So there is a segment, and it solves a lot of needs. I mean, there's this inherent dichotomy. We need more housing, we need more quality housing, and still there's sometimes negative pressure on the providers of that housing.
One follow-up question too, then, as you talk about the trends as it relates to work from home, part of the work from home diffusion a little bit came from, well, I can't actually live close enough to where I work because I can't afford it. So I live out further, thereby incurring a
long
disaffection
commute
for going into the office, right? And so, you know what I mean? So I'm sure there's a connection there at some level where even for, upwardly mobile, college educated folks who just don't want to do the commute in order to have a home, you know what I mean? Like, I'm just curious in terms of how you're looking at that and whether or not there's an innovation. You highlighted some of the cheap land and some other things. I'm sure there's policy issues that would have to also take place at the state level or county level.
For people who can work from home, that has definitely spread out the base of housing options, and it is driving this. You're segueing me right into my next point here. It has driven the ability of people to really spread out and move to Boise or Hawaii or wherever.
Before we move forward, if I may, I want to take us back to Asia. Because correct me if I'm wrong, the way the investments you have made in Asia are more developed markets, Japan, Singapore, and others. So I was wondering, what's your view with regards to some of the emerging economies in Asia, such as Vietnam and others? The opportunities there for us?
It depends on your risk appetite, and my experience has been you're so leveraged against liquidity momentum as opposed to fundamentals, and you rarely get paid for the risk. You'll get lucky on your exit, maybe, but I don't certainly have, and bear in mind, I come from a perspective where and my fellow partners were investing our money with our funds and our clients, and I wouldn't put my money there at the moment. I don't think that's where the opportunity set is. And I like measuring my risk, and I like fairly priced risk and at a lower threshold. And I don't think the opportunity is there at this point from our perspective to justify putting resources there, let alone money.
Thank you for that. Please proceed. Oh, sorry, about you.
Along those lines, I'd be curious in hearing your views on the risks and opportunities in the other emerging markets, whether it's in South America, Africa, Middle East. Are those developed enough for institutional investors yet?
By and large, no. And they have been very, very difficult places to bring home positive returns. It ebbs and flows, but what you've got is you think about real estate market risk, and you need a certain depth of tenant demand and exit demand. And then, that's hard enough. Then you move out of core and into non-core, and you may be having development or redevelopment risk. And all of that and the returns I've talked to you about real estate are for those activities. And then you shift into places, and I haven't mentioned, you also have currency risk, right? And then you shift into places with much more volatile, harder to hedge currencies, and then you adding on political risk and legal system risk and things that have really not worked well for real estate investors in those places before. And you start to get a lot of risk that kind of real estate returns don't cover. And that's where I've had a lot of discussions as part of a multi-asset class group for much of my career, that's where it's like the PE returns are much higher and they justify the potential returns, justify taking on all those other risks. So it has not tended to work to go beyond the deep liquid developed markets.
Thank you. Okay, can proceed, please.
Okay, thank you. If you want to spend just a little before we go into climate, and we do have some time, I want to spend a little bit on the big question, and is kind of where do people want to be in the US? Like, are we going to stay spread out? How are you, is Boise going to continue to be interesting? Are people, and this is also a kind of an unanswerable question, because it depends, as Mary pointed out, at what point people figure out that they actually need to be together to get things done. But how are you guys thinking about this?
I will wade into giving an answer to the unanswerable question. Thank you. This is personal opinion. There's a great phrase saying, you've all heard it, the cure for high prices is high prices. And we may be experiencing that in terms of a shift in some of these marketplaces and some of the supply demand characteristics. The things that made cities attractive 15 years ago, or even 100 years ago, those things are still very much part of the human experience, and they will continue to be. We're just weighing them against a different set of costs and benefits today. And so the costs we've started to talk about, we haven't talked much about the benefits. And some of those benefits are a little bit like, what John referred to in his opening comments, which is the ability to be together, and the fact that we're better together in venues like this, and even in your own personal venues or working venues. This can't be understated. And while I don't think we're going to go back to a full sort of 5-day, 9-to-5 orientation in almost any kind of work, I do believe there is benefit to being together, and that connotes benefit to the office as an investable asset class, as a useful asset class. Now, as I agree with Mary, as Mary said, office, I'm paraphrasing, office has a future, but it's just a future that looks maybe a little bit different from its recent past. And so we don't need offices as a place to go and open our laptop and answer emails, right? That's what Starbucks is for. But we do need offices in order to attract and retain staff, to develop and advance our corporate culture, our values, what we're about, client activity, and so on and so forth. So the office, I'm kind of in an office category now, but the office use as it changes ends up being something that's more responsive to those kinds of needs. And frankly, everything else falls away. And so when we look at changing demographics or even changing growth patterns, we look at it alongside those uses that are going to be most receptive to the best opportunistic return and gain from those changes. And here again, I get back to that opening comment I made about bifurcation. If we can select the right assets, even in the office category, with some of the characteristics I just described in those growth areas, I have faith that even a market today that's experiencing a measure of out migration, that asset in that market can succeed.
It's so interesting because statistically, the growth projections are greater for what we call the secondary markets, but the job creation is still very centered in the major markets. And I think part of the solution there is really that we wind up with more vibrant suburbs again, which we've already trended to.
So on that office, so you have organizations, I don't know if you're familiar with, like Industrious, where you are able to pretty much rent an office for hours or maybe a couple of days a month. That is, what do you think about that? Is that an opportunity for us there, for any investor? Is that the future, or what do you see that?
I think it's part of the future. I don't think it's the full future. The example that people know the most of because of its headline is WeWork. But that model, that flex office model, whether it's Industrious or WeWork or HANA or any of these other labels, I think does have a future. An office concentration, an office building of any material size, I view in the future to be successful probably has a level of that sort of flex office temporary type space. there's probably another degree of space where the landlord has built out a series of small to medium-sized speculative suites. The idea that they're ready for occupancy, sign the lease today and you can be in on Friday. And then there's a matriculation up into the more traditional rental role, 5 to 10 year leases for larger companies. So I think this notion of you sign on the dotted line and that's your space and that's your location for 10 years. I think you're going to see a lot more fluidity, and the industrious of the world will help to provide some of that. I think there's a value for it. Now, the negative as a landlord is most of those arrangements tend to be cost sharing arrangements. They tend not to want to pay a lot of fixed rents to us as landlords. What they'll say is, we'll give you a profits interest in terms of how this store ultimately performs. And so we've got to be really, really careful about measuring our investment in that space against our likely return based on their projections of how they're going to do at that location.
It's very attractive. I'm a member of an organization. We rented an office downtown LA, prime the location for $1,000 a month. You could never do that, but of course, there's limitations. You can only use it for so many hours. The conference room. But it's ideal.
Sure.
People think that we are paying top dollar when we are not.
Like I said, I think there's a component of the office using demand that's perfect for, and I want to have them in a. I don't want them to be a whole building. I'd like them to be 20 or 25% of a building, so that we can offer that alternative to groups like the one you're talking about, as well as service the Fortune 500 companies in the traditional part of our building.
So you inherently get that exposure in a well-run office building in markets where that makes sense, because the landlord's going to be doing it anyway. You don't necessarily need to invest industrious. And if you did, that would be Natalie's job. The other thing from a landlord's perspective is the building, part of the building's value is the leases, and long-term leases with credit tenants are worth a whole lot more than a 1 month lease with a boutique, startup. So it does point to some value diminution as in office generally, as we evolve to shorter term leases and more flexibility for tenants. It's change. Okay. Want to switch to climate change unless there's any other. Okay. Mary talked a little bit about the impact of the buildings on the environment. I want to start by talking about the impact of the environment on the buildings, because that can be dramatic. And one of the things I look at when I look at the US is a lot of people moving to places like Florida and Texas who are very vulnerable to climate change and have hurricanes and heat issues and so forth. And one of the attractions is that these are low tax environments, which means there's not as much resource to invest in the infrastructure at the same time as you need more infrastructure. And we saw the heating grid fail in Texas last winter. And these are very popular markets with very strong real estate fundamentals. So Bob, how do you think about these things kind of in the, past 3 years out, and in the midterm kind of?
Yeah, it's a real puzzle because to your point, we're on the point of that inflection. And it's a couple different inflections. It's not only the physical impacts, which we think very carefully about. We use all of the tools that are sort of cutting edge in this industry from the Moody's ESG. We find that to be a really useful analytical framework to put all of our assets on a consistent evaluative structure, and to be able to compare and try to quantify some of these risks. And that's a part of our business, I think, that's going to really improve over the next even just couple of years, where we start to develop industry standards and consistency so that we're talking the same language about these impacts. But as we try to get our arms around the actual usability here, we do think about in our portfolios how much is too much Miami, how much is too much flood risk or windstorm damage risk. And it varies by client. It varies from a closed-end fund to a separate account, from an open-end fund, and so forth. I will tell you, this might be somewhat controversial. One of the major limiting factors in moving towards more sensitivity in this area, frankly, is our U.S. investor base. Our European colleagues, our global investors have long bought into the fact that this is where the world is headed. We need to be sensible and smart about it. There's often regulation that forces them to be that way. The only time I have the conversation about a recommended investment for sustainability reasons and a request for what's the return on investment is generally here. I don't have that kind of conversation anywhere else around our global investors. So there still is a pull. There still is some education that's, I think, needed in our investment community. And we heard Mary talk about some examples, New York City, London, elsewhere. There will be a whole tier of uninvestable properties. Local Law 97 in New York City, saw it on your slides. This is going to render a whole section of New York City essentially uninvestable by the end of this decade. And so if we're not on this today, it's going to sneak up on people in ways that it shouldn't.
Yeah, and LACERA is focused on it, and you are in the lead among our US clients, not our European clients. And it is very important that we and everybody else start reporting to GRESB and start getting information about this and so forth. The interesting thing is that's just reporting on it. It's not even actually a force to change yet. It's just trying to figure out where we are so we can start measuring change. So we do have a ways to go. And it's going to be interesting to see if we get there before nature does.
Just to make a comment, and the LACERA staff knows that I often make comments when something makes me cringe a little bit, and the assertion that Europe is ahead of the US at a blanket basis is one of those things that makes me cringe, in the sense that LACERA, and we have the following this section is the discussion about our investment beliefs. And one of our investment beliefs that we're going to explore is that ESG factors represent risks. Do we, also represent opportunities too? But from a European perspective, that's about reporting. What we do is incorporate ESG stewardship principles as factors that can enhance returns and or mitigate risks. So I think that it's not a product for us, it's a process. And I think it's really easy for this industry that we're in to make the statement, well, Europe's ahead of the US. I don't necessarily think so. I think that Europe may be ahead in terms of regulations about reporting, but as a US-based investor, on behalf of our 180,000 members at LACERA, we view all information as important inputs such that we can make the best decisions. And I think that certain stewardship principles represent that. So just sharing my observation.
100%. And I mean, it is so valuable because I cite you guys by name or not all the time and trying to pull people along and say, this is what the leaders are doing. Please do this too. And what I meant by that is our clients in Europe are facing regulations that say you can't lease this building if you don't fix it. It's not even coming from a, climate is a risk. It's an immediate, we're in the soup if we don't clean this up. And that is driving a different kind of focus, and that focus with what's happening in the Ukraine. Like if you solved Ukraine and Russia tomorrow, Germany is not going back to depending on energy from Russia. Like they are going to rapidly decarbonize, and their conversation from, a necessity purpose is going to be very different than ours in an energy rich country where we, there's huge parts of the population that still kind of are nowhere on this, like don't get it, don't think it's a problem. So that was a generalization. Sorry. Okay. The other point I wanted to make when I was listening to Bob is, even though there is risk to the building owners and engineers are sophisticated, and there is flooding in Lower Manhattan years ago taught people not to put the building systems in the basement, to lift them up, and there's hurricane proof and resistant things and earthquake resistant things. So there's a lot that can be done to manage your physical building risk in these places in the face of climate change happening to the buildings. the risk of getting in trouble. I know like on earthquake, Japan is potentially ahead of California.
Well, Australia seismic in New Zealand and Japan, significant and been around a long time. But I think to your point, what we're seeing now, if you look at the transition it's accretive to risk and return now. There are technologies and our awareness and capabilities have built up over the last decade to such a degree that every time we're going into investments, and this is growing in the industry, it still needs greater awareness, because I think LACERA is probably a market leader in a North American sense in a lot of regards, in how you frame it, not just in a reporting sense, but how you're practically driving it. It's meaningful now. I mean, we're doing buildings now, we're getting 30% savings by putting energy savings by putting natural water capture systems, putting solar panels on the roof. We're now deliberately looking for renewable energy sources as a power supply. Now, in some markets, we just don't have that availability. But if you'd asked me, were we capable of that 5 years ago in our business? No, but we are today. And I think that's a tremendously positive thing to see as the industry gets more aware and more effective in actually managing it, as opposed to just reporting on it. But the reporting keeps us honest. It started us 10 years ago. Frankly, the Dutch, who have dealt with a major environmental issue for a long time, because it would flood if they didn't put in their systems to manage it, just wouldn't exist. They have forced, in a lot of respects, I think, been at the forefront of getting us all to transition our thinking about it and starting to address it. And it's growing exponentially.
So how does the impact of climate on the buildings, does it affect where you invest in Asia or your portfolio construction?
We fortunately in Asia, if you look at the indexes they have on environmental risk, we're in jurisdictions that are relatively low risk. But we've also had, in the markets where we've got vulnerabilities, we've had seismic, for example, in Japan for a very, very long time. And in 1982, they introduced legislation where you needed to build to minimum standards. We've now got in New Zealand, particularly after the Christchurch earthquakes, we've got increasing standards. It's made, I'll give you an example, Wellington, there are large portions of that CBD, now it's not large, that office buildings are redundant. They are no longer fit for purpose. You can't retrofit seismic in most of those buildings. It's just too complicated. So I think Asia, A, is generally a little bit more resilient. B, it's been well established in some of its practices where it's had vulnerabilities, but it's changing. I think Australia is changing. For example, what's happening on the coastlines now, and the erosion coming from extensive sea activity and changes in the sea patterns and weather patterns that are driving that, are changing how people are looking at residential at places where people used to think that was a premium residential spot. So it's something we have to continue to monitor. We're not seeing it to a degree where we've said, okay, we've got to manage our portfolio exposure in that particular location, but we just have to monitor it. It's a very unpredictable aspect of our existence, weather.
Now let's flip it the other way around. 3/4 of tenants and institutional investors, according to a JLL survey, will have net zero plans to get to net zero by the end of this year. The tenants care about it partly because, according to the survey, they think they should do it, but also because it's a branding issue with their customers.
And with their employees. Increasingly, their employees are saying, I want to work for a place that upholds these things.
But we've got to be careful with the branding issues. It drives me crazy. People going and buying just carbon offsets to get to their zero, that's not making a difference. And so I think one of the big things with groups like this, it's incumbent on us to take responsibility to make the outcomes meaningful. And that's still a weakness in our sector at the moment. The window dressing of ESG and trying to make the world just a little bit better.
Well said.
So you got this, again, a dichotomy where the best way to get to a net zero building is to build a new building, but building a new building is not all that environmentally friendly. How do you think about that? I know in your region, there is a lot of new building, so you can, inherently, but also what exactly do you do to make an existing building, get closer to net zero?
Well, we make most of our money retrofitting old buildings. And it's also usually, if you look at the profile of tenant occupancy, and it's different in our markets. They really are quite diversified, but small to medium enterprises generally constitute anywhere from 50 to 65%. But what we're doing now in terms of retrofitting is that we'll go look at the materials that have been used. We're using much smarter glass paneling that's much more efficient, because energy efficient and retains coolness in the temperate environments like Singapore, where you've got huge humidity outside and you want to keep inside cool. We're looking at glass systems now that can help insulate on a much stronger and more effective basis. We're putting solar panels in, as I said, in Seoul, and on the last 2 buildings that we've done, we put natural water capture systems, which are really helping in terms of reducing energy efficiency and drawing on natural water resources and creating our own. And also, when we go and refurbish a building, what we're doing now is when we strip out parts of the building, because you're getting a lot of potentially redundant materials that don't necessarily qualify in terms of being environmentally friendly. What we're doing though now, and as the industry evolves, is we're recycling a lot more of that material. Now, recycling in Asia and a lot of our markets is not as sophisticated as, say, in the US, but it's developing as an industry, and we're repurposing that material to an alternative use. So I think there's some really interesting trends out there. And as I said, technology and the sophistication in the domestic workforces to enable recycling is improving and on an upward trend.
I have a question. I just want to throw this in because we're getting toward the end of our time, and I want to make sure that you go a little bit beyond the E. I know when a lot of people talk about E, S, and G in real estate, it tends to focus on E, but at the center of community building are the decisions made by developers, and these social issues, particularly in terms of how you determine what is affordable housing, how you consider the makeup of the community, what kinds of workers are represented, et cetera. Those decisions are also inherently made. And so I wonder if you could throw a little bit of S in there as well in that conversation about how you kind of make those decisions within your portfolio, or do you? And, you know, we, unfortunately, as institutional investors, that is the largest source of headline risk for us. And the level of acrimony and animosity in public comment around these things is very, very, I mean, it can be quite cutting, because this is where people live. Your shelter is literally the bottom of Maslow's hierarchy, and it stresses people out the most.
I was a student of Maslow's hierarchy. It's still true, right? It's such a great pyramid to use. I think Asia, for example, and I'll defer to Bob and Margaret on the US and elsewhere, but we're probably a little bit behind in terms of our application on that, and that reflects some of the cultural nuances in our region. But what we are doing, and we're much more socially aware than we were 5 years ago in a lot of our markets. And we're trying to change very entrenched cultural mindsets in a lot of our jurisdictions. It is very different. But I'll give you an example. And we're doing a refurbishment in Auckland at the moment. Now, I spent a lot of time in New Zealand, played a lot of rugby, so it's a bit of a hometown for me. But when we talk about, we've got what you refer as the Maoris. For us, we call it Maori. And you've got a local iwi, which is an area where that particular iwi, or tribe, as you might refer to it, has its history. So what we're doing now as we refurbish this one building is we're getting Maori artists to do carvings in the stone stairways up, and we're putting up art that's absolutely relevant for that community and being respectful to that community. And I think we're doing that much more consistently now than what we did. And so it's little things like that that we're trying to do to make a difference and address the S. Is it where we want it to be? No, but we are dealing with such distinct cultural practices that it's going to take us time to get there in the way we'd like to.
Yeah, it's we've got parallels in the US, although most of our investment activity is around existing assets in the built environment. So it isn't maybe quite so concentrated as a new entrant onto the scene, changing a neighborhood or really impacting the use and social patterns in the immediate micro market. We're certainly sensitive to those things, and we try to deliver assets in the newly built environment that are responding to some of the same community concerns. One area I think that we as managers forget on this dimension, though, is what we can do inside of our own firms. So we're 1,000 people globally, and you know, our focus is how can we lead by example? How can we develop that culture internal to our organization, which then transfers out not only from our organization, but into the real estate economy in general. So things like, training, development opportunities, advancement opportunities from a culture building point of view. From a talent acquisition and retention point of view, keeping some very, very serious statistics on who we're hiring, who we're retaining, who's leaving and for what reasons and why. Things like diverse interview panels, making sure that every single opportunity that we post has a series of diverse potential applicants. And then we think about things like affecting the marketplace through our sourcing of vendors, through the criteria that we select our brokers. It's part of our broker pitch. We ask you to respond on your team and your company's statistics and diversity information. And so I think a little bit like the E in ESG, it's a lot about many, many small but important choices that you make, elevating certain things of importance and doing it consistently so that it becomes part of the overall landscape.
And I'll just follow up on that. And Margaret, I'd love to hear your perspective on this. I understand the notion of changing the culture, but if you don't live in a community, you don't care about it. Right. And if you are not from that community, you don't care about it. And these are the communities that you're often developing in. And so I guess my question is, how do you replace that kind of empathy or even sort of local social understanding? Because you are making decisions about the use of the space, about the social patterns, about, who can ultimately live there when you're done with your process of development. So, I think that's, and I'd love to hear kind of broadly how that's being addressed within the real estate market, or if it is, or if it needs to be.
Real estate is executed at the very local level. If you're going to do well, you actually do have people generally in the community, and they are very aware of those trends. Now, if you're going to build, you're talking about housing, a multifamily property,
or multi-use space, which is,
okay, multi-use is community building, and if you focus on what works in that location, so you kind of have to be aware of the trends. But a lot of multi-use is not within a building. It's like in San Francisco, the area around the Oakland Coliseum is getting completely rebuilt. That is a huge multi-jurisdictional discussion about what goes where. And they're going to decide we need an office building here. And Bob might come in and CBRE would build that office building, but the community creation is a bigger discussion that's kind of preceded a lot of that, not to punt on the question, but it's sort of handled in a different way than just the real estate managers. And anyone who is seeking zoning changes really has to get in there and engage with the community and make it work for the community. Now, you're looking for certain economic returns. And if your economic returns are high and you're building a luxury apartment, you are not going to be supporting, affordable housing base. That's a whole different issue. And that's, as a capital source, where do you want to be? And that's a conversation, there certainly are. I would say multifamily in general is more focused, especially on the rehab side, on mid-market and not the high-end developments, but there's certainly options, and a lot of managers look at them to actually move into the affordable sector, like technically affordable, and do things there that are profitable and that do involve community building. There are some very interesting managers who have done that, and what you get is you build social services into your apartment property, and you get a very, very stable income stream, albeit at a slightly lower return. And so, but you can apply a lower cap rate because the income stream is more solid. So that's a discussion that we can have.
I didn't mean to derail your environmental discussion.
No, but we're here for you.
We have 1 minute for last remarks.
Are there any other questions?
Any?
Okay, we'll do a lightning round. What's your favorite thing to invest in right now? And I'm putting them on the spot. I didn't have to prepare that for that.
I'd go office and data centers in key locations in our region.
For me, I still think a well-designed, well-chosen, well-located industrial development, if you can find them, is really got way more upside than downside for the most part. I'm intrigued by the office comment. I think we're a little early to say I love office. I wouldn't, based on my earlier comments, ever give you a full endorsement for the office world, but I am here to tell you this notion of responsive, modern, forward-looking, versatile, connected office that provides some of the things we talked about earlier will have a future, and I'm looking forward to investing in that future.
Let me try and convince you of one point. Well, Asia workforce participation in most major cities is back to close to what it was pre-COVID. And please don't underestimate the cultural nuance. Household sizes, I'll give you an example, Hong Kong, 45 meters square. That's before we take account of the cultural nuances that really, in Japan, we had to take more space in our office because we were doing 50-50 workforce shifts because our people did not want to go home. So we had to take more space to allow them to come into the office so we didn't have rotation. So I think there is so much variability, and to talk generally is important directionally, but there is opportunity.
From your lips to God's ears. As they say.
I'm not sure I convinced Bob. Maybe I had a little bit more luck with some of you.
Thank you so much.
Thank you.
Nobody didn't take it.
Thank you.
We're getting ready to start. At this point, it is 10:30 a.m. I'm calling this meeting to order. Tribal and distinguished panel, you have the floor.
Great. Thank you, Mr. Chair. Trustees, it's great this is the last session of the offsite, and every session has been the best. This will continue that proud tradition of everything being the best. But I'm really excited. The discussion about the statement of investment beliefs, I think that this is something that has been a priority for the board, first in adopting it 6 years ago. And we've used the statement of investment beliefs throughout our creation of the strategic plan. We cite it in most months in terms of recommendations. So in many ways, this discussion now is 6 years in the making. So it's something that we're really excited about. The process to evaluate our investment beliefs has been a fantastic process that's been led by Magdalia, Krista, and Cindy. They did a phenomenal job reviewing our investment beliefs, looking at statements of investment beliefs of peer plans, as well as working with Makita, and Makita provided some, valuable insight into our investment beliefs and the investment beliefs of their clients. The team created a 3-part survey. Trustees completed the survey, and we'll go over the 3 parts of the survey, which talks first about a framework. The second part is an evaluation of our existing beliefs. And then the third part is really identifying some common themes and potential new ones for trustees' considerations. And those new themes come from what our actual practices are. And maybe my words, so get mad at me, is when you actually parse the words in our statement of investment beliefs, some of them may be too vernacular or may not be that actionable. And my favorite, and I'm paraphrasing, is markets are efficient except when they're not. And so there's certain statements that maybe we can, facilitate a discussion to try to, tighten a little bit. The goal here is to be interactive, as always. We on the panel up here cannot see the trustees that are on Zoom. So if you could just let us know if someone wants to weigh in. And for trustees, please speak into your microphones such that everyone on the Zoom can hear. The goal of this session is not to change for the sake of change. It's to have a discussion after 6 years and also recognize that we've evolved a lot since our investment beliefs were adopted in 2016. We have a strategic plan, allocator to best-in-class investor. We have a functional framework. Back then, we had a traditional asset allocation. We now have a functional framework. We have Tide. It's a fantastic initiative, but Tide didn't exist as Tide back then. Many of the initiatives did. We have a more evolved investment model. We have co-investments across multiple asset categories. Our strategic asset allocation is more diversified. Think, credit and real assets. Those weren't discrete allocations back when our investment beliefs were adopted. And we also have a more comprehensive approach. We have a dedicated stewardship team that we didn't have back then, as well as a dedicated portfolio analytics team that spends time focusing on everything from risk management to asset allocation to performance reporting. So a lot has evolved in the last 6+ years, and we're really looking forward to a great discussion. So with that, I'll hand it off.
All right, awesome. Thanks. Thank you so much, John, and great to be here in person. Great to see everybody. And thank you everyone joining remotely. I am Magdalia Armstrong, and I'm a part of the global equity team, and I'm joined by my awesome colleagues, Krista Powell, who's part of the hedge funds team, and Cindy Rivera, who's part of the real estate team. So as John said, we look forward to this discussion. We'll hopefully be lively. We know we're the last here in this first part of the offsite, so we look forward to it. All right, so let's go ahead and jump to the session overview. So this outlines the discussion for today. I'm kicking us off. And I'm going to touch on objectives, background, and process that we took to review in this recent evaluation. Krista is going to cover part 2. She will go over the summary of the results from each part of the survey. As John reminded us, there were 3 parts to the survey. And then Cindy will kick off the 3rd segment, which weaves parts 1, 2, and 3 all together. And so hopefully in that segment, we can materialize some good feedback to inform our next steps. And Krista and I will be helping out Cindy with that 3rd segment. Okay, so let's jump into the objective. So we all know we're here to talk about the investment beliefs and what is their purpose. And as this slide says, they articulate an investor's fundamental views on how financial markets operate to help guide the investment strategy. So revisiting the beliefs like we are doing today seems reasonable, right? Just like our strategic asset allocation evolves over time. Assessing and staying up to date on financial markets is important. So they inform what our investment beliefs state. You know, we've heard yesterday and today, all the things that are changing and evolving. So it's important to stay up to date. And they should be clear and succinct, right? So anybody can understand them. The evolution of the investment beliefs continue with our discussions that we have between trustees, staff, and LACERA's consultants. Okay, so let's jump into the background and touch on that quickly. As John said, it's been an evolution over these last 6 years. And this is a summary of all the different touch points. 2016 marks when they were adopted and they were formulated together. It was a joint effort between trustees, staff, along with the guidance of LACERA's consultants. And since then, they've been informing LACERA's policies and initiatives. For example, in 2019, they helped shape the board-approved allocator to best-in-class investor strategic initiatives that we all know very well. The other points on the timeline provide background on moments where we've had discussions on the beliefs and how they tie into the initiatives and whether any refinements need to be made. All right. This next slide illustrates the beliefs weaving themselves into LACERA's investment policy statement. And that initially happened in 2018. And at that point, the beliefs were brought to the forefront of the investment policy statement. And they also began to guide and they continue to shape LACERA's investment program. The next slide, you know, we've said this more than once already. There's a lot on this slide, but again, it's an example and an illustration of the beliefs informing strategic initiatives. And you can see here the interconnectedness between the beliefs in the policy statement, the beliefs in the initiatives. And the work plan approved earlier this year was also rooted in the beliefs. So they're weaving themselves into the fabric of LACERA's initiatives and policies. Okay. And then lastly, process. John already highlighted it a moment ago. This is the process we took to evaluate this most recent instance. And, you know, surveys have been conducted at various moments to gauge trustees' thoughts on the beliefs. And today we're here to talk about the most recent survey. So with that, we look forward to the discussion to be had, and Krista will now jump into the second segment where she'll provide the summary of the results from each part of the survey.
Thank you, Magdalia. As Magdalia mentioned, a survey was sent in June to get trustees' feedback on the areas related to the investment beliefs to inform today's discussion. Over the next few slides, we will review the results of the survey based on the trustee responses. The first part of the survey, or part one, focused on how beliefs should be framed. Each construct had favorable responses. In later slides, there will be a discussion on how this framework applies to the existing investment beliefs. Going from left to right, we will discuss each of these results individually, as well as provide an overview on how each construct can effectively frame investment beliefs. Principles-based had the strongest favor. This is the belief that principles should frame trustee deliberations, but avoid rigid rules. The feedback received was that the current set of investment beliefs are not too rigid or constraining. Mission relevant also had strong favor. This means beliefs should be relevant to LACERA's fiduciary duties to produce returns, protect capital, and provide the promised benefits to LACERA's members. In other words, investment beliefs should be framed in a way that focuses on earning returns to meet or exceed the actuarial return targets while mitigating risks and managing liquidity. Trustees were mostly agreeable to beliefs being succinct. This means that beliefs should be a relatively short document as opposed to a lengthy document. Some of the feedback received was that while the belief shouldn't be too lengthy, we shouldn't restrict it to 1 to 2 pages, placing importance on content over quantity. Lastly, all response favored investment beliefs being actionable. This means that throughout LACERA's regular course of the investment process, beliefs should be framed to provide insight on how to approach and optimize portfolio implementation. Part two of the survey focused on the current set of investment beliefs to gauge trustee sentiment on current relevance. As you see, there's strong favor across each belief. You'll also notice some neutral responses. I will highlight some key observations. However, further detail will be discussed in later slides. Strategic asset allocation and education were most favored. Paraphrasing what is written on page 5 of the investment policy statement, strategic asset allocation is key to meeting LACERA's mission and investment objectives and sets the expectations for risk and return objectives. It stresses the importance of diversification, risk management, liquidity management, and meeting return objectives from a total fund perspective. Education is highly favored as a key driver to success as well. The markets are always evolving, and understanding core concepts of investments and the investment strategies result in better informed implementation. Areas with more varied responses include market efficiency and active versus passive management. In its current form, market efficiency states that markets are largely efficient in the long run. However, there are certain economic environments where markets are less efficient, which allows for more tactical allocation. As John said earlier, markets are efficient except when they're not. This partially ties in with active versus passive management, where the beliefs state that market inefficiencies may be more likely in certain asset classes relative to others, as opposed to isolating certain economic conditions. Broadly, the belief is that markets are largely efficient over the long term, but there is also acknowledgement that inefficiencies exist, and thus tactical allocation or selective active management makes sense to optimize returns. Another area of slightly varied responses is costs and fees. This is the belief that costs are one of the many factors that determine investment outcomes. They have the most certainty, should be actively monitored and negotiated. While this received responses that mostly agreed, there was one neutral response. Some investors focus on net of fee returns as opposed to explicit fee reductions. Private markets and liquidity and risk receive strongly agree and agree responses across the board. These will be discussed in further detail in later slides. Here we'll focus on part 3 of the survey, which covered prospective new themes. While there was agreement on each theme, some themes were less favorable than others. As a reminder, there was an option on the survey to include additional beliefs that weren't captured in the survey questions. While we didn't get any feedback on the survey, today's discussion welcomes any conversations around that topic. Let's start with themes that had varied responses. Return optimization received mostly neutral responses, with some agreement and one response that strongly disagreed. This proposed that existing themes focused on active management, liquidity, and prudent risk-taking could fall under an umbrella belief of return optimization. The decisions to tactically allocate to active managers, take additional risk, or invest in illiquid assets each aim to enhance portfolio returns above market beta or passive management. Some of the feedback received on this topic was that each component is too broad and not applicable to all asset classes. Therefore, it's important to define guidelines within each and requires individual focus. Governance and stewardship had mostly favorable responses, but it's worth highlighting that there was one strongly disagree response. While ESG and stewardship are mentioned within risk, part 3 of the survey sought feedback on if ESG should be further defined as both an investment risk and an opportunity. There will be more on this later. Other areas that didn't necessarily have agreement, but did have split responses include operational effectiveness, diversification, global perspective, and capital markets. First, operational effectiveness is the belief that operational efficiency may impact the portfolio's success. Things like technology, sound processes, and procedures contribute to operational effectiveness, which has the potential to directly impact the success of the overall portfolio. Second, diversification is currently a sub-belief within risk, stating that diversification across several factors is necessary for risk mitigation. Part 3 of the survey proposed expanding on this concept to include return enhancement potential through diversification. Third, global perspective also received a couple of neutral responses and exists as a sub-belief within risk. LACERA operates in a global financial marketplace, and it is vital to possess a global perspective. It was mentioned in yesterday's globalization discussion that LACERA's geographical exposure has grown over time. Furthermore, as markets in general have become more globally diversified, there are several factors to consider, such as expanded opportunity set, increased diversification, and alternative return sources. Capital markets also receive split responses between agree and neutral. Investment beliefs aim to frame LACERA's views on capital markets and how to prudently invest given certain views or assumptions. It was mentioned at the August Board of Investments meeting that no matter how the markets are performing broadly, LACERA has a fiduciary duty to achieve an annualized actuarial return target of 7% in order to provide the promised benefits to its members today and tomorrow. This survey question sought feedback on if actuarial targets should be included in the investment beliefs framework as a separate but related factor when considering capital markets views. Themes that received mostly favorable responses were total fund approach, LACERA influence, human capital, and transparency. These will be covered in later slides. Next, Cindy will kick off the detailed discussion of the survey responses.
Thank you, Krista. Let's see, next slide here. So the upcoming discussion weaves together parts 1, 2, and 3 of the survey that trustees participated in ahead of today's meeting. The goal here is for this session to be interactive, so please feel free to jump in with thoughts or comments as we go through these slides. As was mentioned earlier, since 2016, when LACERA adopted a statement of investment beliefs, our investment program has undergone some very important refinements. I'll summarize them again. A couple of these are that LACERA asset classes went from a traditional to a more functional framework. That was a pretty nice and meaningful change. We've created a strategic plan to go from allocator to best-in-class investor. On an annual basis, we identified a work plan that is interwoven with LACERA's investment beliefs, which in turn serves as the foundation for our investment program. We highlight the interconnectedness of these endeavors as we take a deeper look at our organization's investment beliefs.
Our objective is for LACERA's investment belief statement to articulate our organization's views on how financial markets operate and help guide the organization's investment strategy. This is important not just internally for the team, but also externally, as it helps clearly and explicitly communicate our investment beliefs to existing and potential partners as well. In part 1 of the survey, trustees considered a beliefs framework with 4 main components shown here on this slide. These main components may help assess and shape LACERA's investment beliefs. So we'll go through them now. First and foremost, and because everything we do is rooted in our mission, we want to ensure that investment beliefs are reflective of LACERA's mission to produce, protect, and provide the promised benefits. Second, investment beliefs that are principles-based help guide trustee deliberations via broad principles rather than rigid rules. Third, a succinct, in essence, a short and clear investment belief is preferred over a lengthy and perhaps even confusing format. Lastly, actionable investment beliefs are helpful when executing the organization's investment strategy. On the following slides, we will evaluate each of LACERA's existing 7 investment beliefs. These were presented during part 2 of the survey. We will also be evaluating the 10 prospective investment beliefs and themes that were presented as part 3 of the survey. Together, we're going to apply this framework to review our existing and potential investment beliefs, and we'll go through the survey results from trustees as well. For this more engaged part of our discussion, we present information in a consistent format. The top right corner that you see here is a table with the investment beliefs framework that we saw in part 1 of the survey, and we hope that it will help guide our discussion about these investment beliefs. The top half of the slide will consistently show LACERA's existing beliefs. These are being shown in order of appearance in our existing investment belief statement. And the bottom half, shaded in this light blue or gray background that you see, is represents the related prospective beliefs and themes that we considered in part 3 of the survey. Please note that prospective and existing beliefs that are on one slide represent themes that we feel are perhaps complementary to each other, and these are not mutually exclusive. We're not looking to replace any of the existing content, but rather add where there may be some correlations and natural relationships. We also will highlight that the colorful spectrum to the right states the level of trustees' agreement with such statements per the survey. So with that walkthrough, let's jump into strategic asset allocation, which is our first investment belief and lightheartedly referred to as John's 3 children, strategic asset and allocation. It is LACERA's belief that long-term strategic asset allocation will be the primary determinant of LACERA's risk return outcomes. Asset allocation is expected to have a greater impact on returns, even more so than other factors such as asset class structure and manager selection. We go on to add that it is important to be forward-looking and to rebalance the portfolio. Trustee survey results reveal a strong level of agreement with this statement. If we focus on the existing belief of strategic asset allocation and we apply the framework to it, we find that perhaps the framework is met and that this statement in its current state is mission relevant, principles-based, succinct, and actionable. However, there might be opportunity to add some actionable context. In part 3 of the survey, trustees seem to generally agree with incorporating language about LACERA's total fund approach and also the capital markets considerations. We welcome feedback from trustees on whether we want to add actionable context regarding LACERA's total fund, which is part of how we apply strategic asset allocation, and capital markets considerations, which is a reflection upon which strategic asset allocation is built on. Would trustees like to add to this perspective, or should we move on to the next investment belief? Okay.
Open.
I just had a question about the inclusion of the capital markets discussion, and I guess I was just curious to staff of what prompted that to become highlighted specifically in this, I know this was a proposal that you have, but what prompted you to pull that out specifically for discussion in this particular section?
Oh, great question. So throughout this presentation, what we're trying to reflect is the interrelation of a lot of what we do and we present and bring to the board. And so the component of capital markets, we thought it might be relevant because these assumptions play an important role in our actuarial framework. And so as these assumptions may evolve over time, and they often do, we should keep in mind the potential impact that it would have on our investment strategy overall. So if we perhaps include some of that language, it might help us be more intentional in memorializing the importance of that relationship.
Piggyback off that. I think one of the things that a lot of plans fail to do is evaluate the differences in the assumptions made on the asset side of the equation versus the assumptions made on the liability side of the equation. And sometimes they can be quite different. And to assume that these things will happen at the same time in different ways is simply absurd. And I think the idea that we're going to, as an organization, ensure at least some consistency between both sides of the equation to ensure that they in fact do equate is not only mathematically reasonable, but it's just common sense. And so I just want to support that thought process.
Anybody else? Anybody virtually?
I just add one thought on there, and as far as the capital markets assumptions, I mean, they are also the building block of every part of the strategic asset allocation exercise. That's the main component that we do. So not even from the actuarial perspective, but really from the development of the strategic asset allocation itself. And I think there might be an opportunity. I know there's going to be one later on diversification, but I think diversification could also fit under here. I think right now it's within the risk management belief, but to the core of strategic asset allocation is the benefits that you get from diversification. So just a couple of thoughts.
Thank you for that. Anybody else? I agree with Gina. It's something that we should be. Anybody else?
Well, thank you. Thank you for that valuable feedback. We'll move on to the next slide. The second investment belief in LACERA's investment belief statement is that financial markets are largely efficient over the long term, except during times of disruption when LACERA will allow for modest tactical adjustments to asset allocation. If we focus on the existing belief of market efficiency as it is currently written, and we apply the framework to it, market efficiency seems to be a general principle that LACERA follows as part of its mission relevant investment strategy. However, it is not as clear whether this statement is succinct and actionable. Some clarity is lost in saying that markets are efficient, except when they're not, as we've mentioned earlier in the presentation. In part 3 of the survey, trustees also considered inclusion of language on transparency. The transparency of markets and manager mandates. So we should be clear about that. All else equal, managers who are transparent with LACERA are preferred over those that perhaps are less forthcoming. Per the survey, trustees generally agree with LACERA incorporating language addressing the importance of transparency, but we'd welcome additional feedback from the board if we have any from trustees.
Floor is open.
Thanks.
I do have a comment. I mean, one of the, I absolutely believe that the markets become inefficient and that we have to allow ourselves the ability to make tactical decisions. I worry a little that the nature of our timing can be less than optimal when some of these inefficiencies may only last for 6 months. And so and even some, elements of how we have evolved our asset allocation can at times be years late. So I wonder to what degree you think about how we can combat that issue, meaning let's fight battles we're likely to win, and let's try to create opportunities to take advantage of these inefficiencies despite the sort of bureaucratic nature of how we create, I mean, if it takes 9 months to get through an RFP, and personally, I don't think it should, but it seems to. If that's the case, often your market opportunity is lost by the time you get around to making the allocation, getting through the legal process that can take another 6 months. And so a year and a half later, you're done. It's a really challenging notion. And so sometimes giving managers more flexibility can be an answer in order to create more nimbleness. Although you can lose control of your asset allocation in that way. So I'd love to hear your thoughts as to how you're thinking about that aspect of inefficiency and you know, tactical thoughts.
A couple thoughts, if I may, are, and I wasn't here in 2016. In 2016, when this investment belief was adopted, LACERA had an allocation of up to 5% for tactical allocation. And I think that might have shaped this to a certain degree. And I think one of the challenges with just a total tactical type of approach is you can't really benchmark it because you don't really know what it might be. It could be anything. And the point is very well taken that we have to reconcile that which is practical with the opportunity set. And I think that we've done it in several ways. One is the board has delegated to staff co-investments and secondaries. I think that allows us to be very precise against a set of principles and rules and a budget put forward by the board. Same thing as it relates to re-ups, that we could potentially do things in a more timely manner. And this ties into a different investment belief, but to do so at a lower cost by potentially being in a earlier closing. A third aspect is, and I think we discussed this in an offsite in 2017 or 2018, was that the concept of springing mandates. And it's something that we've done in the credit portfolio, for example, is where we've made larger allocations that have capital ready to be deployed. For example, if credit spreads go from 200 to 500 or more, that capital is already committed such that when conditions are met, the capital can be deployed such that our process, and it's defined what it's for, such that it's not the unknown like just a tactical allocation might be. So I think that it is an issue, but I would say that our process, and maybe this relates to, and I'm all over the place, for which I apologize, but it's great, is the notion of the importance of good operations and technology and transparency, that the more we know about what's in the portfolio, the better the real-time information, the better the reporting to the board, maybe that expedites and gives us greater understanding of what we have and what we may have. So there's just a couple of thoughts.
Anybody else? Virtually. Done?
If I could maybe just add one thing on this topic as well. I think this presents maybe an opportunity to, in the context of market efficiency, differentiate between public and private markets and how you might approach the sort of concept of market efficiency and the sort of, you know, different decisions that might be based on the relative lack or presence of efficiency in some of those asset classes.
I think that's a great segue to the next slide.
It is. So on this slide, we cover the third and fourth investment beliefs that are in our current statement. And these are active versus passive management and private markets and liquidity. We identify passive management as the preferred structure of our investment management. However, we do recognize that some asset classes may inherently necessitate more active management and higher fees as well. Such higher fees are considered in the context of greater expected risk-adjusted returns. With private markets comes less liquid investment strategies, which must be kept at a prudent level. Trustees tend to strongly agree with these statements and communicated a sentiment that markets are largely efficient, but there are inefficiencies to be found, and that in such cases, higher fees are justifiable. If we focus on the existing beliefs of active versus passive management and private markets and liquidity, and we apply the beliefs framework to them, these beliefs seem to meet the framework of being mission relevant, principles-based, succinct, and actionable. In part 3 of the survey, return optimization was included as a perspective theme for one main reason. In reviewing our existing belief statement in its entirety, we find several characteristics that may be focused on enhancing portfolio returns are stated as individual and separate beliefs. This appears to be perhaps a fragmented approach when compared to our investment belief on risk, which you will see on the next slide, and it has a sizable text. Trustees generally agree to our neutral, with LACERA incorporating language on an umbrella belief of optimizing returns. We should point out that when we mention return optimization, we're not talking about an investment model focused on that one number that might, give us an allocation of put everything in private equity. It's not that sort of exercise. Rather, we are focused on perhaps having a balanced view of risk and returns in our investment beliefs. Trustees warn against being too broad and layering such an umbrella belief that may be at odds in some asset classes. So this context came from the commentary that accompanied the survey questions as well. For example, public markets are passive while real estate is more active. Would trustees like to consider a returns umbrella belief similar to what we've done with risk and try to maintain some sort of balance in that presentation? Or leave it as is? We can address that question now, or perhaps after reviewing the next slide that is focused on risk and Krista will cover. Yes.
Okay, backwards. I'm just going to talk. No, don't move the slide, but I mean the upper part of the slide. I want to point out a bit of an oxymoron that's on that slide. The notion of being tactical is usually done in the liquid markets, whereas the notion of being tactical in the private markets is like making short-term bets in a long-term way, because you are responding to short-term opportunities in a way that will last you 7 years. So I find that to be a little incongruous with the actual notion that you're trying to suggest that somehow the private markets are a way in order to make tactical decisions. I would argue that when you look at the tactical nature of opportunities, there are short-term events, medium-term events, and long-term events. And the problem is that you rarely know. We thought that inflation was going to be a short-term event, and it's turning out to be a medium-term event, possibly could become a long-term event. And so that opportunity is morphing literally in front of our eyes, and how you manage that. The other problem is that the long term is often made up of many, many, many short terms that in which you have to make decisions. But the nature of private markets is the idea that you want to give the manager the leeway to play out a medium to long term idea without the need to have to liquidate that idea before it has come to fruition. And so I would be careful to characterize those as tactical responses to the markets, because they're not. You are in bed with these managers for 7 and sometimes with extension 10 years. And so, it's just a thought to think about and a kind of criticism I would make as to how you're presenting it, because I think that it to the non-investor is not clear. I think it sends a mixed message.
Thank you for that feedback. And we'll take that back and put that in context with the feedback from the board via the survey, the commentary today. And then also we received survey responses from our staff as well. So we're putting all of that together and strengthening these investment beliefs as much as possible.
Anybody else?
Can I just
Yes, please.
frame this and build on what Cindy was saying, just to see if trustees have a thought behind the concept of return optimization, and maybe Natalie and Jose can cover their ears as I say this, where we say in one of our investment beliefs that certain asset categories justify higher fees. I don't fundamentally believe that. I don't think that we should give private equity a free pass that, well, you're a private equity firm, you can charge more. I think that we should identify opportunities and express that market opportunity in the lowest cost, most liquid, most transparent way possible. To the extent you can't do that in public markets, maybe then you do it in private markets. But I think that I think that justifying higher fees is something that we should always be cognizant of. And maybe if we do it through the lens of after all expenses, after all costs are parsed, then maybe that it's the right return optimization for the fund. But I think it's something that we should always try to do. Is my personal investment belief is never pay more than we have to just because a label potentially is on an investment.
Can I, oh, sorry, go ahead.
I did have I wasn't here obviously in 2016 when, this was looked at. And I imagine during that time, there was probably a need to address private markets separately and call it out and, put emphasis on it. And to what Mr. Grable was saying, probably there were some assurances that needed to be said about the fees and the fact that if that's going to get us a higher return, we got to be willing to pay those fees. But I think from what I have observed, our ideas have shifted towards private equity into more of the concept of creating more of an umbrella belief that kind of just covers everything. We don't have to call it out separately anymore. And you're right, we should just be getting the best returns with the little fee as possible and not necessarily having to focus in on one area. So I guess I'm curious to see are we ready to maybe transition the language here to have more of a broad range umbrella approach where we don't have to specifically focus on, a category that maybe wasn't as widely acceptable back in 2016 in a pension, setting.
Mr. Chair, just
before I go to Gina, I'm sorry, go ahead.
Can I just
absolutely?
And I think that Ms. Jones, I think we may have done that when the board adopted a functional framework, where right now we have a growth asset category, which is public and private equity together. So I believe that in practice, the board has potentially done that already.
Yeah, I just want to say before I call on Gina, is that you are quite correct. At that time, there was a belief, look at the returns. Don't worry about the fees. And if you have good returns, who cares how much you're paying fees? To me, it was problematic, but that was the theory at the time. So we felt that we needed to include something like this. But things have changed. Like Mr. Grable said, we have evolved tremendously from 23 billion to over 70 billion on the management. So there's been a big change. And just to provide a little history here, it took years for us trustees to convince everybody that we needed to develop the investment beliefs. It was a big fight. So there was a lot of compromise. Different board now, different ideas. So it's time to review and change. Ms. Sanchez.
Speaking of moving too late, I would like to remind people and use this as a moment of education that much of why money was driven out of the public markets into the private markets, there were several kind of steps to that evolution. It began with this sort of the rise of hedge funds and the ability to leverage became a big draw away from public markets in the sort of general, growth value, long only context. That was driven further as we started to really get into this glut of liquidity that began in 2001 and has since continued. That glut of liquidity has probably at this point reached its pinnacle. And regardless of what you believe the Fed is going to do and how far they're going to go to fight inflation, the reality is that we are now seeing the Fed balance sheet contracting for the first time in a very long time. And that is not going away, regardless of whether or not you think that a year from now, the Fed's eventually going to start cutting rates after, we've had either a mild or a vicious recession, depending on who you ask. The notion that the Fed will have either the mandate or the desire to expand its balance sheet I would not make that better. I would take the other side of that bet with you. Now, we're obviously talking about a lot of fiscal money that may go into some opportunities in infrastructure, et cetera, et cetera. And so there may be some sort of fiscal support for that. But the really broad factors that enabled illiquid assets to continue to gain a premium over public assets was largely because the entire valuation mechanism was broken in a world of extreme liquidity. And that liquidity benefited also stupid asset classes, collectibles, wine, art, crypto, lots of things that have no inherent value except what the next person is willing to pay for. And when there's excess cash in the system, there's excess money for that sort of thing. But as we start to see the ebb of liquidity, or rather the tide of liquidity ebb, you will have a better valuation process. Now, I'm not saying we're there yet. I think it's going to take years before we're there. But as you have a better kind of valuation opportunity within the public markets, you will see active management in the public markets come back to the fore. And you will see the desire to lock your money up ebb and ebb and ebb. Fees are the hurdle as to how intelligent and smart and how big the opportunity has to be in order for you to jump over that and still deliver return to your ultimate client. And I do think that we have to continue to remain vigilant, because as the excess liquidity goes away, so too will the opportunity. If anything, you're already starting to see it. You're seeing at the venture and private equity space, you're seeing a slowdown in deployment. You're seeing more and more. And if you look at the best returns in terms of vintage years, it's often in the most scarce environments. And I think that we actually may have a lot of stupidly valued things in our portfolio that may not come out to where we thought they were going to be. So you have to be more tactical in terms of, or really more deliberate about how you make that exposure. Although I think there will be better opportunities, but you will also see entire firms fail in the process. And the firms themselves 20 years ago were much smaller. They're huge now. And so the notion that they need that fee in order to keep the lights on is an absolutely absurd one. And so, I think that all of these things are things that we've discussed at the board level. And I, like John, am going all over the place, but I'm just simply saying that it's not a foregone conclusion. And if you allow all equity to be either public or private, it will end up all private, all locked up, and you will be able to make no decisions. And I just don't think that that's a prudent thing to do from a plan perspective. So I think we've gone as far as we need to go in that, from my perspective, and this is just my voice. Take it or leave it.
So you agree, Gina, that principle needs to be amended?
I think we need to think about it in terms of what's going to happen, not what has happened.
And Mr. Chair, just to loop back Ms. Sanchez's comment to her very first comment on the first investment belief, capital markets. To the extent we better understand and have a core belief in capital markets. Yesterday, we heard that the Fed's going to raise benchmark rates to 5%. We're going to asset allocate fundamentally different. The fixed income portfolio is going to look really juicy. If we're trying to get 7 and if we can get 6+% in low risk fixed income, a lot of this conversation is moot.
Good. Anybody else? A consultant?
I just think, to Gina's other points, if you elevate this return optimization maybe to the top of this belief, it sort of covers everything you said there, right? Where You're looking at these different tools and building blocks of return, but it's not saying we inherently favor one versus the other. Whereas right now it's kind of like bifurcated by, where you would 100% approach it active or passive versus having that flexibility.
Yes.
Anybody else about virtually? None? Okay.
Okay, thank you for the constructive discussion. We will move on to the next slide. Risk. In the survey, this was part 2 and paraphrased as risk is a broad term used to capture the concept of uncertainty. Since no single metric adequately conveys risk, LACERA will evaluate risk holistically, incorporating quantitative measures and qualitative assessments in managing its portfolio. Risk diversification is necessary globally across different risk factors such as ESG and conflicts of interest. Risk that is not expected to be rewarded over the long run or mitigated through diversification will be minimized. The general survey consensus was strongly favorable to risk as an investment belief. As seen on the slide, risk is a pretty lengthy belief in the investment belief statement. I'll highlight some key observations. There are potential areas of redundancy when the belief makes reference to diversifying risk factors in order to mitigate risks. This is referenced in sub-bullets B, G, and H. Sub-bullet B succinctly states that diversification across risk factors is necessary for risk reduction. In sub-bullet G, ESG is considered relevant to the investment process and a risk factor. Furthermore, governance as part of ESG would capture factors like conflicts of interest, which is singled out as a risk factor in sub-bullet H. When we consider portfolio implementation, there are several risk factors that are considered material. No single factor prevails another. Additionally, some of the sub-beliefs lead to unclear direction or dissonance. Sub-bullet C states that markets are cyclical, risk premia, volatility, and correlations vary over time. This frames a view on capital markets, but doesn't necessarily provide insight on how it influences portfolio implementation. Sub-bullets E and F say that risk that can't be diversified or when not rewarded in the long term will be minimized, while simultaneously saying that not taking enough risk is risky. Lastly, sub-bullet D states that the pattern of returns matters because the volatility levels and the sequences of gains and losses can impact funded status and contribution rates. While this is particularly important considering LACERA is a mature pension and is cash flow negative, this doesn't provide clear direction on how to approach risk in order to achieve a stable pattern of gains and losses. In aggregate, the risk beliefs may not provide clear or consistent direction. As we apply the framework of mission relevant, principles-based, succinct, and actionable, I'd like to welcome feedback from the trustees on how this applies to the existing belief.
Please, the floor is open.
I actually don't have any comments on this slide. Continue.
We can move on to the bottom part.
Wait.
Okay.
1 minute, Ms. Jones.
Oh, sorry.
I think I just have more of a question or a couple of questions. I agree your comment with E and F. They do appear to conflict, but I'm not sure if there's a way of synthesizing those two concepts into one, statement where we acknowledge that we need to mitigate risk, but it is necessary for, the returns that we're trying to get. So I don't know if there's a way to consolidate those two statements. I think it'd be smoother than having one come right after the other that almost appears to contradict it. I mean, and that's just, my thoughts on that. But then on the question that you have down below for diversification, I guess I agree with the fact that, yes, the two objectives should be not only to mitigate risk, but to enhance returns. But is staff recommending that be incorporated in the language up above, or I was a little confused of or what would we change?
Yep.
Is that what we would do?
No.
Oh, okay.
So the idea here is, at a high level, is to streamline the risk belief, make it high level and concise and clear in one direction. So with global perspective and diversification below, the idea is that these are total fund perspective, strategic asset allocation. I think Tim mentioned this earlier in the discussion, that as we think of strategic asset allocation, the core concept of that is diversification. And I think as we think about the total fund perspective, these two factors below, diversification and global perspective, would roll into that, and not be just viewed in a single risk lens.
Can I just also explain something that you asked, Ms. Jones, that I think, because you didn't get to it, the items E and F, was it E and F or D and E? Oh shit, which one? Which ones? E and F, right? So those are different items. They are actually not related to one another. One is that there are risks for which you are simply not compensated to take. That's different from the notion that risk is an optimal concept. Too little or too much is bad. There is some optimal level of risk that we all agree to sort of take on as a plan. There's this notion that risk is good or bad. It is neither. It is simply the business that we're in, and that we need to strive to determine what is optimal. So item F is really saying that not taking enough risk is as bad as taking too much risk. Item E just says only take risks you're going to get paid for. Don't take risks you're not going to get paid for. So they're unrelated concepts, but you might want to think about wording.
I guess I do understand what you're saying, but I also understand the other perspective that when reading it, it could be.
Yeah, I think it's confusing.
Yes, it could be viewed. And that's why the question was, is there a way to put the two concepts?
State it a little better.
Either collectively putting them together, or yes, rewording it in a different fashion.
Any comments, Tim?
I have a question.
The topic of risk, I'd say overall is fairly complicated. And I think this slide shows that, but I do think there's an opportunity to make it more succinct and to the actionable part, provide a little bit better direction. So I think there's a big opportunity on this belief, but I don't have a perfect solution right now. So
I think Mr. Kelly
I have a question.
has the floor.
John, I have a question.
Yes, you have the floor. Do you hear me?
Yes, I can hear you.
Okay, you have the floor.
Okay, thank you. So I guess to follow up on Ms. Jones' comment, I'm a little bit confused on this slide here, because I don't understand actually what the proposed revision is, or if there is a proposed revision, or if at this point you're just collecting kind of thoughts about suggestions. Because I don't see how this particular, how what you're proposing makes this more succinct and makes it more applicable in a broad nature to some of the issues we face. I think that's the problem I'm having with this discussion, not only on this slide, but on other slides. So you're not proposing any definitive changes to this document at this point. In other words, we're not presented with a red line here. You're discussing potential changes with us for incorporation to a revised draft that comes back to us. Can you talk a little bit more about that process?
Sure. The process is to solicit input and feedback, and subsequent to that, we can come back to the board with potential moderations, elevations, adjustments. But the goal here is not to present something to the board as, you know, A versus B. This is really the process of really taking some input to then think about, do we need to do something, and potentially what?
Okay, and I guess in my mind, the survey was the mechanism through which you would gauge kind of the thoughts of the trustees as part of this process. That we've done that part already.
The survey, I think part of it was the survey results were very narrow. So I think that the goal of this session really is to expand upon that, just to see potentially to socialize, to discuss it, to see if people had different interpretations of a question. But this is not design. We don't have alternatives, at the ready to make adjustments.
Got it. Okay, thank you.
By the way, I welcome that.
Yeah.
Because I think it's very important. We did the survey. We understand what my colleagues are thinking. It's good to be able to discuss it and then come back and revisit this with a more formalized proposal. Somebody else? Have their hand up?
No, I was just gonna say, I think what we kind of have decided, if I think, is that you're going to take away the comments that we've made here and come back with a more succinct version instead of this long laundry list of things that relate to one another, don't relate to one another. There's a couple of things that are actually the same in different bullets, and you're gonna come back to us with a more reduced version of this. Is that right?
Yeah, we're gonna come back with some formal proposals for the board to consider at a later date.
Anybody else? Okay.
If I may
let's
make
move forward.
just a comment, is the commentary, the feedback received has been very refreshing so far, because we were hoping it would go in that direction, but we didn't know if trustees felt, why change something that, has worked well for this last, so many years. So we're very excited to come back to you with that at a future date, but thank you for that.
Okay, we'll go to the next slide. Here we focus on costs and fees. As stated in the investment beliefs, successful investment strategies are dependent on net of fee returns, and as such, costs and fees should be actively monitored and negotiated. This received favorable responses. I think as we look at the framework, this is mission relevant, it's principles based, it's succinct and actionable. Does anyone want to provide any sort of feedback on this before we move to the bottom of the slide?
Please.
So thank you. It was interesting yesterday how we heard about the tech spend had gone from 2 basis points to 3 basis points. I think over 10 years is what was mentioned, and just kind of back of the envelope analysis means we spend maybe 3 times more on tech spend than we used to. And I've been thinking about that since yesterday, and one of the panels talked about tech spend, and I was listening to this thinking, okay, we talk about fees, but do we have, and piggybacking on what you said, Mr. Grable, the better the tech, the more info we have, to make investment decisions. Do we consider tech spend as part of our investment beliefs? Do we isolate that? Are we just assuming that we'll always have the necessary budget and tech spend to support a reallocation when necessary? So I don't know if this is the perfect slide to bring that up, but I was trying to figure out when that might be.
And Mr. Knox, I believe that the subsequent slide talks about operational effectiveness and the importance of that. So I think we're happy to discuss it now, or we can.
Wait, but that was my concern, was just how we fold that into this process. Thank you.
So remind me, Mr. Grable, I know at one point, and as part of the evaluation that the staff will conduct to a particular manager, at one point, it used to be an allocation, a point allocation for fees, and then some other point, it was decided that we're not going to even look at that. Where are we with regards to I know the staff does a tremendous job in negotiating fees. I've seen those reports, which you'd be very proud of. But what relevance in the due diligence process those fees play?
Fees plays a very important part. I think that the prior slide about risk talked about multiple factors. That is a factor. And it also goes back to my belief that we should never pay more than we have to. But we've done a tremendous job collectively in areas such as, once again, I mentioned illiquid credit before, where we've negotiated, hard fee hurdles or investor profit retention. We've negotiated from getting 70% of the profits to mid-80s. And on, allocations that can be up to $1 billion, that's huge. And I think that we had the notion that potentially, I remember over the summer, I thumb to the wind discussed that we had some initiatives that probably saved us $50+ million over the last couple of years on an annual basis. Our PE co-investment has saved us a lot of money. So fees are an important determination for us. It's part of the discussion. All our returns, we show net of fees. And in December, we're elevating our annual fee report, which we're required by law to show for private markets, to all asset categories. So it's something that we want to keep in front of us.
I think just to make sure, so beyond the kind of specifics of the fees, what I take away from this, and maybe it's being influenced by the perspective, belief, and theme, it's just the recognition by the team saying, because of our size and our footprint, I know you say I have a personal belief, I don't believe we should ever pay more than we have to. I think it's kind of weaponizing at some level the fact that because of our size and footprint, we can be more assertive when it comes to the risk factor of fees and cost. And I think that's different than, hey, are we just getting the cheapest price? I think it's one is saying, because of our critical mass, we have the ability to assert an impact on fees that a lot of other people don't. And then therefore that benefits our members in doing so.
I would agree with the notion that and if we look at the manager scorecard, which is in the board package this month, one of the pillars is strategic value. We look to create strategic relationships, and we have a fiduciary duty to pay no more than we have to, but we don't want to, we want to make sure that all our business partners are institutional quality. So that's part of it also. So you have to make sure, and I don't mean to undermine what I said before, but we have to make sure that our assets are all safeguarded. That's critical to it. But we look at the value collectively. We look at the value of the strategic relationship, and in certain circumstances, we may commit more capital to get better terms. And I think part of the notion of LACERA influence is that it's not just costs and fees, it's terms. Terms is transparency. Terms is building a strategic relationship. Terms is future capacity rates. We've negotiated in hedge funds, revenue share relationships. We want good terms. Terms are a critical element of costs and fees. This may be just missing the comma for terms. And I think that's what influence tries to include.
Support that a little bit as well. I think inherent in your comment is, one of my kind of chits has always been the notion of paying very high fees to extremely large organizations. But on the flip side of that, the reason that these fees often emerged is because you wanted the institutional quality of the organizations that you had. You wanted them to be able to respond to you in an institutional way, have institutional, disaster recovery, and all of the things that create kind of greater or just reduce risk in terms of the organization. And the one place where that still comes to bear is actually in our emerging manager programs. And so, the one thing you don't want to do is say, we're going to support emerging managers. And oh, by the way, we're going to milk you for fees when it is going to hurt you the most. And it actually hurts us as investors. So I agree with you. And I think that that's that one context that you do have to consider, that we want to have the notion of diversity of opinion, experience, perspective, et cetera. And that through parts of the emerging manager program, we get that, but we probably shouldn't do that at the lowest fee that we can as an organization flex to, because that is not in our best interest. And so I agree that there has to be some flexibility around that notion, and that the idea has to be that we get better outcomes. And whether it's fee or you know, other terms that can be very beneficial and valuable to the outcome of the organization, that is important.
Like future capacity rights.
Right, exactly.
Anybody else? You're done? We'll move forward.
Okay, I think we mostly touched on the bottom part of the slide with LACERA's influence. I think in expanding on some of those terms that John mentioned, there are some legal terms that can also benefit LACERA that can be negotiated and have been negotiated. So terms just broadly can be negotiated, and LACERA, given its size and position, can be a term maker instead of a term taker. Taking note of that flexibility that Trustee Sanchez just mentioned. With that, I'll hand it off to Magdalia to finish the session for us.
All right, thanks, Krista. So we're almost to the finish line. Now we're going to talk about education, which is the 7th belief in our stated beliefs. And I'll start off by stating what it says, which is, in an increasingly complex and dynamic investment universe, continued education on investment concepts and investment strategies within that universe is essential for long-term success. We all know education is important, and given the strong agreement in the responses, it should continue in the investment beliefs. The idea we're throwing out is perhaps that we build out on this belief. We posed 2 questions in part 3 of the survey, and you see them at the bottom of the slide, that may be additive to this belief in the attempt to make it more holistic, where education is one component to the overall success of the program. And the themes considered are human capital and operational effectiveness. If we go to the first question, human capital, in the corporate governance and stewardship principles, human capital and DEI are recognized as elements that can influence performance. Most respondents strongly agreed or agreed with one neutral on this question. The idea being that if you invest in people to further their education and training, and promote a culture of diversity, equity, and inclusion, which ties into LACERA's TIDE initiative, it can influence performance and therefore drive the long-term success of the plan. Moving on to operational effectiveness, the response to this question was not as strong as human capital, and as almost half of the respondents were neutral on this question, and the rest were in agreement. And so this question deserves some explanation why we put it here. And the idea with operational effectiveness goes back to this idea of a holistic view, what it takes to run a successful investment program. Because you can hire a highly educated, knowledgeable group of people, but if you don't equip them with the right tools or instill sound processes and procedures, you'll likely decrease the chance of success of the investment program. So I'll just bring up an example. For those of you who've been here for a few years, the process and procedures for operational due diligence, or ODD, were revisited and reassessed by staff. And with the goal to improve upon and make the process more robust. So again, it's this idea about improving upon processes contributes to the overall success of the program. So, going back to what you asked, Mr. Knox, about technology, I think with, on the prior slide with cost and fees, we can certainly negotiate fees explicitly, right, with our investment partners. I think what you had raised was the technology of the plan, right? And I think that does come along with the operational effectiveness in terms of, you know, what you equip your team with, right? We want sound technology. We want the best technology. I mean, with the sheer size of the plan, it's important that we have the right tools to navigate in these markets. So that said, these two themes are for the trustees' consideration, which may be additive to the education belief. And again, it's to make it more holistic, where education is one component to the overall success of the program. So I'll pause there to see if there are any comments on these two themes.
I have a comment, Joe Kelly. Thank you. I don't know if it makes sense to me to incorporate human capital and operational effectiveness into education. I think education to me means we want really bright people. And that's aligned really with human capital as well. We want to retain and attract. But what I'm also interested in is this issue of operational effectiveness, because it does speak to Mr. Knox's comment earlier in my mind. So for example, technology, we employ an enterprise-wide risk management system that we pay for. It's not, we don't allocate it that cost as part of specific asset classes or deals. The same you could say for our legal efforts, our lawyers, they look at all these deals. And it's not cheap to have legal, internal and external, look at these deals and sign off on them. So there are a whole bunch of costs that we incur that we don't consider under the cost issue we discussed earlier, because those are the costs we pay out to managers and others, custodial, et cetera. So there are really two sets of costs here, and I think we do have to look at our operational costs to ensure that they are that they're reasonable, to ensure that we have the best systems available. I just don't know if it belongs under education in my mind. I think it's a separate category. And I do think we have to think about costs at some point as all-inclusive costs, though the costs we pay to external managers and third parties, and then the costs we incur to run a really great operation, an efficient and effective operation internally, from risk management systems to legal, et cetera. So those be my comments. But I think human capital and operational effectiveness are key to consider. I just don't know if they belong under education or if they're separate categories.
Thank you, Mr. Kelly. Ms. Sanchez?
I'm going to slightly contradict Mr. Kelly's comment, but in a friendly way, hopefully. Actually, all of these things do share one common attribute, which is that they are productivity enhancing, and they are about increasing the productivity of the organization. So, you know, education, investing in the best form of capital, making sure that we have all of the right human capital, or that we even have human capital, is exactly in line with also ensuring that your human capital has the right resources to be able to work efficiently. So all of these are productivity enhancing. And so I would actually retitle all of this productivity rather than just calling it education, because I think that's actually too narrow a thought comment. So it's just something for you to take away. And the other thing that I would say, and it's kind of in response to Mr. Knox's comment about operational effectiveness, I referenced in, I think it was in the venture comment, a McKinsey study that basically talked about the sort of digitization, if you will, of various sectors. And what I find interesting is that we are actually we are spanning a chasm of digitalization in that the knowledge sectors, the very top level of the knowledge sector is, you know, besides technology directly, is the financial world is actually very highly digitized, in that if financial organizations and asset managers have invested very heavily in analytic tools and things that make their workers more effective and more productive, as well as how they present their data, how they interactions, how they do vendor management. That area of the industry is very, very highly digitized when you sort of count up the investments made by those organizations. At the very bottom of the digital spectrum is government. Government is the last bastion of non-digitized entities. And sometimes I think part of it is that digitization works against labor creation. And so if you're gonna, if you get too efficient as a government organization, you need fewer people to do your stuff. And I loved the comment that offices are like the repository of stuff that hasn't been automated, because it's absolutely true. However, we as a group very specifically have to be able to due diligence and ensure that the investments that we make are sound from a place where we are in a culture that moves very slowly in terms of digitization. And so I think that the idea that we've been underspending and probably chronically underspending on our sort of, let's call it worker support, worker productivity, data access, we have probably been chronically underspending for years, consistent with the rest of government, right? I won't take any knocks at your office, Keith, but at the end of the day, I think that we are sort of dealing with two very, very distinct and extreme cultures that we have to, that we as a group are trying to ensure that we understand, and then ensure that our team is getting the best human capital. And that part of that human capital is, if I come to work for you, am I going to be successful? Are you going to be able to provide for me the kind of access to analysis, or do I have to go back to the abacus, right? That's the main question that's being asked. And so I would kind of think about retitling this as sort of human productivity or labor productivity. And I think it is inherent in what we do that we are at least reasonably competitive with the organizations that we're trying to keep an eye on.
I support Gina's recommendation of somehow collapsing all three into one category. And I echo some of her thoughts and concerns. The only thing I would like to add is, on the education piece, we have the term of being essential. And I'm wondering if there's a way we can have a stronger word that means that we have this standard, right, that is mandatory for how we operate. It's not that it's important, it's mandatory, it's required. It's something that we, pride ourselves in making sure that our staff and our board members are educated as much as possible. So that's my only thought there. Other than that, I
Required than the government code. Mr. Graber.
Just to provide an example, going back to Mr. Knox's question as to the benefit of and the reason behind the greater technology spend, factoring in Mr. Kelly's comment as well as Ms. Sanchez, is when our investment beliefs were first adopted in 2016, we custodied a minority of our investments. We now custody, I don't know, 70% maybe. I don't know what the exact number is, but it's maybe it's double what we used to custody. We instead of closing the books on a monthly basis, we close them on a daily basis. In fact, so we get we don't close the books, but we get a daily NAV of the portfolio. That technology that is budgeted and approved by the boards helps us rebalance the portfolio on a daily basis. We do that through our cash overlay program. That cash overlay program last year was probably the difference between LACERA having a negative return and a positive return. So I think that there's tremendous value in actionable, in demonstrable results for LACERA and its members by virtue of having greater portfolio insight that's brought about by the digitization of the financial industry that is out there for our implementation.
Mr. Masrini and then Mr. Knox.
Yeah, it occurs to me that the concepts of human capital and operational effectiveness are broader than just the investment office, and they permeate the entire organization. So I'm wondering, and I see our CEO nodding, I'm wondering, since we're in the process of revisiting LACERA's strategic goals, whether this should be lifted up to that, because it permeates the organization, as I said. And then our beliefs and IPS can reference that or piggyback off of that. So I just throw that out there for discussion. Because it seems like this is a broad topic that.
So I understand this correctly, is that you're suggesting that we should include that as part of the total organizational belief and continue with the educational section here. Is that what you're suggesting?
I'm just throwing that out.
I just,
No, I appreciate it.
I think the one thing is the ultimate strategic plan's unknown at this point in time. I think that's important I think that they can connect, but I think that we shouldn't punt to the unknown.
Right.
I would agree with Mr. Grable. I don't see any reason why it can't be included in both areas. Because it is incredibly important. One of the things when you look at this particular strategic plan on the investment side, it doesn't really reference in terms of the support functions that are needed. It talks about the consultants, talks about the managers, the money managers, it talk about my finance folks, my legal team, and the importance that they play in terms of negotiating the agreements and so on and so forth. And so I think it should be both. And then once the strategic plan is the overall strategic plan will have a component in terms of how does LACERA, the overall strategic plan, support this particular investment strategy that you all are discussing at this point in time. And so that's, at least that's the way we've discussed it. John and I and my team, and I just want to recognize that Mr. Luke. So this is good feedback for us to take back, and we'll make sure that we focus our attention on the support functions for implementing this particular strategic plan.
Thank you, Mr. Kryman. Mr. Knox.
Yeah, just quickly, I like the idea of codifying this in this area just as a measure of support and tying it into the investment, beliefs, because we've talked a lot, and you in particular, Mr. Chair, about the importance of filling vacancies. And I think we assume that there's overhead there to get you the IT infrastructure you need to work from home and such. But I don't think we talk enough about just this tech spend like we did yesterday to help improve, the opportunities that we have to get the return that we need to hit. So I appreciate that. Thank you.
I'm going to echo basically what Ms. Jones and Ms. Sanchez said, but just maybe perhaps in a slightly different way, where Ms. Sanchez labeled it productivity. I think you could say something along the lines of continuous improvement is critical to LACERA's ongoing success, and then use these as the sort of underlying components of it. And then just sort of a nitpicky one, hearing some of the conversation about the importance of some of the internal costs and resources, maybe just adding a bullet point on cost, fees, and terms to reflect, that you do have these internal costs and recognize it there, and maybe pull it away from here.
Jones.
And maybe we could say it as investments versus a cost.
Right.
Because
I like that.
Just
Yeah.
sounds better. And the other
A hardened government staffer speaking.
The other thing that when there was a mention of codifying the strategic plan, but I also wonder if there's a place at the end of this where we reference some of the other policies and procedures or frameworks that you've even mentioned today that correlate to some of the items throughout the policy here, and maybe doing small footnotes that can connect to the other documents that support more detailed language on each of these items, because I know you have, for example, on the fees, you have policies around the fees. And I don't know if there's a place at the very end to just reference those other documents. Just a thought.
Thank you. Anybody else?
And we're almost done, Mr. Chair.
Please.
One more slide.
Yeah.
No, one more slide.
Take your time.
All right.
Well, that's all great feedback. All right, so now we are at the end, and this is governance and stewardship. So this question was asked in part 3 of the survey, and it asked if we should consider language that defines how ESG and stewardship are relevant to its investment process and objectives as both an investment risk and opportunity. We also included the question from last year's offsite that asked to possibly separate out LACERA's belief addressing ESG. So let me provide some background first. And we currently know, or we know that ESG is within the risk section of the investment beliefs. And, you know, we all saw it in the prior slide. And it only characterizes it as a risk to be managed. Now, since then, LACERA has built out further policy that recognizes ESG factors can also present investment opportunities. And we've heard that discussion yesterday and today. The current language characterizes ESG as only relevant. It doesn't say how it is relevant to the investment process to guide action. So you can see some excerpts here that we inserted from the investment policy statement. I'm not going to read all of them. And these have been added in the recent years subsequent to the adoption of the ESG investment belief. So the first statement clarifies relevance by saying that ESG may influence the risk return profile. So in other words, it presents not only financial risks, but again, financial opportunities. The second statement recognizes financially material ESG factors may vary by industry, geography, business strategy, time horizon, among other things. And the fourth statement, I'll point out, speaks to accessing and managing diverse talent, leads to improved outcomes. And again, this is making the connection with LACERA's TIDE initiative. So these excerpts flesh out the relevant statement and it give it more definition around the how. And the other thing to consider is that perhaps by omission, it implies where it is not relevant. The word on its own can be vague to those outside of LACERA. So the response on this question was generally favorable, but with an opposing viewpoint. And the comment expressed is that we don't want to tie our hands with overly restrictive language. We also, as I mentioned, we inserted the question from last year's offsite, and you can see here the results of whether ESG should be pulled out of the risk section. So I'll pause here to welcome any discussion to unpack the comments just made. And then as we have these discussions, if we could touch on those two questions, first question being if ESG should be pulled out of the risk or ESG be its own belief. And second, do we want to go beyond the relevant statement, recognizing the financial opportunities and flesh out a risk to be managed, regardless whether ESG is on its own or not. I'll stop there and welcome comments.
We're trying to figure out the logistics where we should take lunch right now and come back and revisit this.
Okay.
There's been some suggestions, so we're trying to work out the logistics to see. What's the answer?
We're going to continue with the meeting.
Okay.
Right after.
Board business may not be long.
Okay, so then we can adjourn for lunch.
Oh,
No, it's a continuing meeting.
Gotcha. All right. All right.
Rally, all right.
And the floor.
All right, so at this point, we welcome any comments on ESG. And again, the comments if we can touch on if ESG, if you think it should be its own belief, and second, we go beyond the relevant statement and talk about the financial opportunities and not just the risks that come with
Okay, the floor is open.
That's a complicated question that you're asking.
Understood.
And I think if you think about E, S, and G are kind of they're categories of metrics that for the most part refer to financial disclosures that tend to be seen as risks, as sort of risk factors, and that are still working through the process of becoming standardized. We're mid-cycle in that. We're farther along than we used to be, certainly, but I think that the challenge there that we have is just trying to figure out, what is an apple, what is an orange, and what is a peach, and how can we convert those to fruit salad so that we can compare them. And so, I think that E, S, and G are generally referred to, I think, as risk characteristics. There are elements that they refer to that sort of go beyond kind of, let's call it quantifying these things into kind of the question as to what is the impact and outcome of your investments, and does that create risks and opportunities for you? Meaning, if there are certain metrics that show higher participation in of minorities, women, et cetera, then is that an alpha opportunity for an organization? I think these things are still very murky, even in specialist spaces. I attended a real estate conference recently, and this topic was brought up, and there was dead air. I mean, literally dead air in the room. And so I do think that each industry is moving at different speeds on this. The question of disclosures and how we embrace the supportive disclosures, which disclosures, are they GRI standards? Are they SASB standards? Are we supporting GRESB? There's a lot of different players still at this table. We've seen a lot of consolidation over the last 2 years. And so I don't know that even the sort of sector, that space itself knows what it is, where it's going yet. I agree that ESG and sustainability and these questions are questions that we inherently have to think about as an investor and as a responsible investor, to quote a notion that was more like 1990s. And I think that it represents as much an opportunity in the form of well-run businesses as not. However, I think that there is still an era of investment returns that you could get away with by externalizing costs. And that kind of characterizes the late 70s, 80s, and even into the 90s, that if you could make a buck and shunt it onto the municipalities where you were making that buck and get away with it, then who cares? The legal pathways still aren't even fully formed around whether or not there will ever be recourse for some of the harms and excesses that have occurred. And we as an organization have probably, well, there's no question that we have benefited from that. And so, what do we do about that? So these are really, really complex topics that I think, we have to continue to ask the question, if what you're looking for is, should we just make it a separate place and at least accept that it's more than just a risk, it's also a return opportunity, then I'd say that that's probably as far as you can go right now, because we're still figuring it out, as are you. Yeah.
Mr. Chair?
Yes, sir.
An observation for the board's consideration is the acknowledgement of ESG factors is most tepid in our statement of investment beliefs. We have a statement right after our investment beliefs in our investment policy statement about ESG considerations. We also have a stewardship policy, and those statements are not about impact. They're squarely within the fiduciary box of what our responsibilities are, but it acknowledges both risks and opportunities. And is 2 or 3 sentences, and the board expanded that last year during after the strategic asset allocation, when we updated our investment policy statement. And maybe a thought is, because that language was scrutinized by the board, that potentially just move into the investment beliefs.
Yeah, I mean, I think that the notion of at least making everything on par with one another and consistent, that makes a lot of sense. But this is something we're going to continue to do a lot of work on, without a doubt. And I think we as a board, my perspective is that we should, we should say this is something that is important to us, and we're going to scrutinize it to the extent that it applies to our fiduciary obligation, without a doubt.
Anybody else?
Just quickly, and I've shared as recently as this morning with Mr. Drazel how we get occasional external inquiries, on the defined contribution side, my role here with the pension board, just on what we're doing related to ESG is a common inquiry. So I think, to the point that you just made, I think where we can be consistent and where we can have these themes presented for all to see is a good thing.
Anybody else? Yeah, so I agree with many of the comments, but my concern is that we don't want to be in a situation like some of them. Here, pension funds where they get criticized because they just decided to allocate a certain amount of money to a particular program with an ESG, and then they lose money, or the returns are not as robust, and so the way we've been doing it has been very opportunistic, and that is wonderful to me, because at the end of the day, we do have a fiduciary duty to maximize the returns and minimize the employer contribution. So that's the only concern that I have, that when we build this, because this is a document that is going to live, is going to be here when I leave and many of us are gone. So I want to make sure that we think about that, how the future trustees would look at this document and how they're going to interpret a deliberate process here.
Thank you for saying that. I think in our discussions, we've said as well that we hope to come back to you with something that serves as a timeless piece for this, because it truly does guide our program in great ways. So thank you for touching on that as well.
Because a lot of times when you get negative publicity on a particular program, it really has a chilling effect in the industry, and creates a lot of problems. Members will definitely be on the phone with us. Every time CalPERS sneezes, we get a phone call and say, we're going to get a call. So that's the nature of Anyway, anybody else? Mr. Jones.
So I got a question from a staff perspective on this question. Is there a sentiment around having a more out front posture at all? I mean, I know you guys are close, you see it every day, and the way we don't. We see the headlines and stuff, but we're not like in it. Is there some type of sentiment within the investment staff around this that might be helpful for us just to know as a data point in terms of how they feel about it?
Oh, I was just going to offer up the other data point is, we did look at peer plans, and they do call it out. It's on its own. So that could be another data point. And, with just how we're elevating it as well, I've only been here 18 months, but, so far my experience is that it clearly has been elevating year over year. So I think that's another clear indication of how LACERA feels about ESG, or in governance and stewardship in general.
One other thought for trustees to consider is, I don't think that this is a big discussion, in the sense that it's potentially about geography within our investment policy statement, that the investment policy statement has a robust statement about ESG considerations. It's just not in our investment beliefs. So just maybe the notion is just, once again, moving it up. And because it is, as Magdalia was saying, it's part of every discussion that we have, because to us, ESG is a process, it's not a product. And I think where people trip themselves up is by productizing it. We're very clear this is a process to enhance, outcomes for our members, but potentially it's just the geography of the state.
As a follow-up to Mr. Jones' question, I'd be interested to hear from Mr. Maseriti and any comment with regards to the question that Mr. Jones asked about your staff. You have any views based on your experience? I'm calling you because you've been here as long as I have. Just about. So
I think he just called you old.
I know. There's no question about that.
No, thank you. I'll just echo comments that Magdalia and John made. I mean, over the years, and 10 years ago, this wasn't a consideration. It certainly within the industry, and even more so at LACERA, has gained prominence. And so I think it merits, as John said, moving it into the investment beliefs, because it is a firmly held belief that it's an important consideration in our management of return and risk, our fiduciary duty. So, yeah, thank you for calling on me, but yeah, I think we're all in alignment here.
All guys have to stick together. Anyway, any other comments? Mr. Philip?
I have nothing further to add on this one.
So I think I'll do the last slide, which is, I think this has been a robust and fantastic discussion. And I think that all our objectives were met in terms of having input such that we can come back to trustees for ideas. Once again, the goal wasn't to foster change, it's to maybe just better reflect how our program has evolved. But we'll come back at some point over the next couple of months. This has been fantastic. And I think that Magdalia, Krista, and Cindy did a phenomenal job facilitating this.
Thank you.
Mr. Grable, it is wonderful to see mostly women up there. It is talking about ESG, right? Here we are. We have a perfect example. So thank you very much. At this point, unless any further comments, questions, we're going to adjourn the meeting for lunch. Again, thank you very much. Really appreciate it. What happened, Linda?
I thought we were just gonna
Take a break.
No, we're taking a break.
Thank you,
everyone.
Thank you.
Linda, did we pay the light bills? Anyway, we are recording. I'm calling the board meeting to order. It is 1 p.m. and we do have a quorum. The first item on the agenda is approval of the minutes for August 10, 2022. I will entertain a motion.
So moved.
Second.
It's been moved and second. Any corrections, changes? Hearing none, roll call.
Thank you, Mr. Knox. Mr. Green? Aye. Mr. Kehoe?
Aye.
Mr. Jones?
Aye.
Mrs. Jones?
Aye.
Mr. Kelly?
Yes.
Ms. Sanchez?
Aye.
And Chair Santos?
Aye.
Okay, the motion passes unanimously.
Did you call Mr. Kehoe?
Yes.
Yeah.
Oh, okay, good. Thank you. The next item on the agenda is the CEO report. Mr. Kryman.
Trustees. Really, very brief CEO report. I provided you with a written report. Just wanted to update you on a couple of items. In terms of the strategic plan, we're in the process of working with all of our staff. The action planning teams have completed their work, and now the executives and senior level staff are looking at trying to identify what pillars we're going to focus in on and what recommendations we'll be making to the retirement in the Board of Investment trustees. And so we're continuing to work forward with that. And I appreciate Mr. Grable in his willingness to assist and provide some staff on the investment side of the shop so that we incorporate some of the support functions that they're going to need in order to implement the strategic plan that the Board of Investments has is moving forward on. So we're planning on having a joint meeting next week. I believe that Bonnie or Linda are in the process of trying to set that up. We're going to be discussing a couple of items, but the return to the boardroom will be one of the items that will be discussed at the joint meeting. The communications plan, we're moving forward with that. It's going to be incorporated in the strategic plan. So we're still working through that. We've been working with EKA, our consultant, on the external communication plan, and then our communications team is putting together the internal components. Cost of living adjustments, I'm happy to say that they were implemented and everybody was, I'm assuming, happy with the
Hallelujah.
cost of living. So, the safety member elections have concluded. The Board of Supervisors are expected to certify the election in October. And so there's an unofficial results of that, but I'll report out in October when it becomes official. In terms of recruitment updates, we continue to work with Mr. Grable and his staff in terms of identifying some additional staff on the FA3 side for the real estate division, the senior investment officer. I believe we've made a selection on one senior investment officer. I think Mr. Grable will talk about that later. And we're moving forward with Mr. Rice's request for additional positions on the legal side. I believe he's in the process of interviewing. Mr. Grable and his team is in the process of interviewing for those other items that I spoke about as well. We're making some progress in terms of the support staff that are needed on the accounting side. We're interviewing candidates. I believe that the exam closed last Monday. I think there's something between 15. Making progress in terms of making sure that the investment team is being properly supported. So with that, the retiree healthcare update, I did meet with the deputy of the county's CEO's office in terms of lifting the lifetime cap. And so we're in the process of evaluating. We're waiting for information, written information, in terms of a plan that they would like to propose in order to lift the $1 million cap, but address the issue. So we have made some progress in that area. So we'll be reporting that out to the Board of Retirement in next month as well, in more detail, and the IBLC committee. So with that, that is my report. I'd be more than happy to answer any questions.
Any questions? Comments, Ms. Jones?
Notice in your report that the classification and compensation study is currently under bid review. So I was just curious to the timeline that you anticipate for that, because I do know, as we discussed previously, that's another key component for, attracting good candidates and retaining them.
I don't know the answer specifically to that question, so I will get that answer for you and I'll report it out.
A question related to that.
Mr. Kelly.
Yes, thank you, Mr. Chair. Santos, I'm a little bit confused on the classification and compensation study. Was that board approved, and was it approved for all classes or just for the investment office? I remember it coming up for discussion and one or more trustees said it would be a good thing to do, but I don't remember a board action on it.
I believe that, do you remember? I don't think we got board approval for that, I think that we are initiating the class compensation study for our investment as well as all of the other positions as well.
So you're saying you initiated that?
Carly, do you know the answer to that question?
Dr. Natoya, can you hear us?
I can. Can you hear me?
Yes.
Okay, good afternoon. The classification and compensation study that is under review that is listed in the board packet is for different classifications that are not investments. So they are an RHC study and an HR study. We have not gone out to bid or gotten solicitations for any other classification and compensation review.
Okay, I just want to be clear about what classification studies they were. Thank you very much.
Thank you.
Any other questions? Hearing none, I will entertain, thank you very much. Okay, all right. Chief Investment Officer report.
Thank you, Mr. Chair. And I'll just mention briefly, because I know we've had a long couple days discussing various investment topics. The CIO report is in everyone's board package. I'll mention that this is the results through July. July was a very strong month. The fund was up 3.3% net. Fund value at $72.6 billion, cash at over $1 billion, and asset allocation all within target. OPEB was up by more, given that OPEB is more sensitive to public market movements. OPEB was up 5.7%. Those are the comments. I'm happy to stand for any questions that the trustees may have.
Thank you, Mr. Grable. I think for the past 2 days, we have asked sufficient questions. And assuming there's no questions included virtually. Here, go ahead, Ms. Jones.
That I did see the shift with OPEB, so I was very pleased to see the positive returns for OPEB.
Totally. Thank you. Any other comments? Hearing none, we're moving forward. Going to consent items. Subsection A, recommendation to, well, that's a consent item. Any questions on that? If not, I will entertain a motion.
I'll second.
Move on second, a roll call.
Mr. Green,
Aye.
Mr. Kehoe,
Aye.
Mr. Jones,
Aye.
Mrs. Jones, Mr. Kelly,
No.
Ms. Sanchez,
Aye.
Chair Santos.
Yes.
Okay, the motion passes with 1 no.
Thank you very much. Moving forward to non-consent items, subsection A, Mr. Perez.
Santos and trustees. So the next item on the agenda is a recommendation to approve BlackRock to manage a long-term U.S. Treasury bond index portfolio for the OPEB Master Trust. In your board package today, you should have a recommendation memo as well as a concurrence memo from Makita. For a little bit of background, on June 2021, the OPEB, the board approved a new asset allocation for OPEB. Just like the pension plan, within that allocation, there's a discrete allocation to long-term government bonds. So as part of rebalancing and then to gain the initial 3% allocation, which is approximately $70 million, we're recommending BlackRock long-term U.S. Treasury bond index on an interim basis. I say interim basis because our plan is to launch a search for all of OPEB's public markets next year if the board approves. And that search should help us with OPEB to gain better economics, evaluate several strategic initiatives, and also continue OPEB's move to look more like the pension plan. And the last thing I do want to mention is that BlackRock is currently the long-term U.S. Treasuries investment manager for the pension plan that the board approved of March of this year. And with that, that concludes my comments. Chair Santos, and happy to answer any questions.
Thank you. Any questions?
I have a question here.
Yeah, Mr. Kelly.
Thank you, sir. Jude, if the board were to approve this, what is the total percentage of assets that are under BlackRock's management?
Total assets with BlackRock? They currently I'll answer that question, or Chair Santos, Ms. Kelly, I'll answer that question for OPEB. They manage, I'm going to say basically 100% of OPEB except for a small cash piece, but it's 2.4 billion, I think it's as of today's numbers. I did check them this morning, but that would be the total AUM that they have.
Okay, and what about the pension trust? What percentage do they manage of the pension trust?
They have the ACWI. I mean, not they, actually it's less than 10% because they have just the IG currently right now, and then some Euro tilts for the
So
equity.
less than 10. Okay, thank you very much.
Any other questions? If not, I will entertain a motion.
I'll move the item.
Is moved and second, roll call.
Mr. Knox,
Aye.
Mr. Green, Mr. Kehoe,
Aye.
thank you. Mr. Jones,
Aye.
Mrs. Jones, Mr. Kelly,
Yes.
Ms. Sanchez, and Chair Santos.
Yes.
Okay, the motion passes unanimously.
Great, thank you. That concludes the non-consent items. We're going into reports, unless there's a particular question or comment regarding any of the reports. If yes, the floor is open. Mr. Grable.
There was one report, if it's possible for the team to present. It's a short, I
Absolutely. Which item is that?
believe it's A.
Okay. Item A. The
So,
floor is yours.
do we have the slides? Yeah, there should be a presentation, Alex, at the end of the quarterly report. And so Chair Santos and trustees, Dale Johnson, John Kim, and Tara Elijah are going to go through a small presentation, a short presentation over the performance book for the numbers ending fiscal year June 30 of this year. So that's the goal for this report, and hopefully we could pull up the slides.
Sorry, Mr. Chair and trustees.
Worries. So good. Has been a very successful 2 days.
Good afternoon, Chair Santos and trustees. We'll kick off the presentation on slide 4 with the quarterly snapshot. And this dashboard view was created to provide a quick recap of the total fund to the board. A few metrics to highlight on this slide will include the public market fees for the growth category, which was a 6% year-over-year decline, or approximately $6 million in annual fee savings. The next is the batting average of 41%, which represents the percentage of our managers that outperformed their benchmark. And during a quarter where we saw the global equity markets decline by 16%, surprisingly, our growth and hedge fund managers delivered and make up primarily of that 41%. And lastly, the persistent low tracking error of 2.3, relatively for the trailing 36-month period, that has been consistently steady. And that's just another testament that staff continues to monitor and mitigate risk. Next. With that overview, we'll move forward on a review of our asset allocation. And we closed the fiscal year with $70.4 billion. And as a refresher, this is a snapshot of our new functional asset allocation structure that was approved last year. First, 2021, the first is the creation of a 5th functional category, overlays and hedges, which consists of our cash overlay program and our currency hedge mandate. And then next, within the risk reduction and mitigation functional category, we have a discrete 5% new allocation to long-term government bonds. And just a final comment on the policy weights. So on July 1st, 2022, a couple months ago, we had our final half-step implementation into our asset allocation plan. And so over the next fiscal year, we expect both our over and underweights to further tighten over the year. Next slide. This slide is our performance summary page. And for the quarter, the total fund declined by 5.9%, but it beat its policy benchmark by 200 basis points on a net of fees basis. And for the fiscal year, we fared even better by outperforming by 470 basis points with both growth and credit generating strong excess returns. And if I could draw your attention to the cumulative return chart at the bottom left, there you can see a clear turning point at the beginning of 2021 where the total fund has been consistently generating separation from its policy benchmark. And as of the end of this fiscal year, we've accumulated in excess of 800 basis points of excess returns over that 3-year period. Next slide. This slide presents our contribution to return. So this is referred to as our absolute return attribution because it doesn't compare the results on a relative basis. It just uses the weights within our total plan and the return that was contributed by that functional category. So you'll see from at the functional category level, it was mentioned that possibly without the overlays and hedges composite, we might have been produced a negative fiscal year-to-date return. So the single positive contributor for the quarter was the overlays and hedges category in a tough equity and bond quarter. So all other functional categories were negative, with the growth category being the main detractor. It accounted for roughly 80% of the total fund's net return. And not surprisingly, on the far right side, you'll see that the MSCI ACWI IMI passive account, which is our largest account in the total fund, was a top detractor. This slide is a relative return attribution. So it identifies the sources of excess return and helps us to better understand the results of our active investment decisions. So in contrast to the prior slide where here we see all categories contributing positively on a relative basis, and the main drivers of the fund's overall total value add were the large selection effect in growth at 1.01%, and embedded positive interaction effects within both growth and real assets. And for reference, the interaction effect can be thought of as the amplification or dampening in negative cases of the selection effect based on our allocation decisions. So I'll just give a quick example of that. So if we have an outperforming manager and we actually over allocate to that manager, then you'll see an amplification of that positive interaction effect of the selection. Here we present our risk versus return scatter plot. One interesting observation to highlight is the positive Sharpe ratio, but negative information ratio for our real assets and inflation hedges category. Both metrics are indicators of risk-adjusted returns, but mathematically very different. Just for reference, the Sharpe ratio compares the return of investment to its risk. So in other words, the higher the investment Sharpe ratio, the more returns it's going to offer relative to its risk. The information ratio, on the other hand, focuses just on the alpha component and primarily evaluates the skill of our investment managers. So ultimately, the higher the information ratio, the more consistent that they're producing excess returns on a risk-adjusted basis from our managers. And the last slide finally is our full reporting structure of the total fund, including all the underlying composites that roll up to each functional category. And I just wanted to highlight 2 key takeaways for the fiscal year period is that later when you review this slide, you can see that all of our functional categories beat their policy benchmarks. I thought that was pretty impressive feat. And then 2, while we're in that fiscal year period, private equity and illiquid credit were finished at the top of our leaderboard, and they doubled at the 1-year return, they doubled their assigned benchmarks. More than doubling it. So I thought that was pretty impressive too. And kudos to that team or those 2 teams. And with that, I'll turn it over to Tara to cover total fund risk.
I have a quick question on that. The private equity, how much of that reflects any kind of lag in terms of pricing?
Yes. Since these composites roll up to the total fund, and ultimately we need to produce that headline number, it does follow the accounting hard close fifth business day. So those valuations do have a quarter lagged implication.
So it's 1 quarter lagged.
Yes, and the benchmark is lagged as well. But we do have a new performance system, Solovis, that does cash adjust, and we do have an independent live view side where we can kind of get the best available kind of real-time estimates of performance and valuations.
Afternoon, Chair Santos and trustees. I will go over the total fund forecast. For the fiscal year end. At the top, you can see that the forecast total risk is at 12.9%. Increased market volatility that we've seen has driven that number up incrementally each month over the last several months. The active risk relative to the policy benchmark is at about 1.4%. And that has remained fairly stable around this number, plus or minus over the last several months. It's consistent with what John mentioned for the tracking error. The top bar chart breaks down that 12.9% total risk by asset class. And we see that growth is making up about 80% of that risk due to the exposure to the volatile equity market I just mentioned. The bottom of the slide decomposes risk by factor types, and we see graph that private equity factors were the largest contributor to active risk. We'll see that number decrease in July. As John mentioned, the final strategic asset allocation targets went into effect. And so we'll continue the factor type information on the next slide. So this chart, we decompose risk by factor groups as well as by asset class. The sum of the bars that you see here add up to that 12.9% mentioned before. Looking at the colored bar in the middle for real assets and inflation hedges, it has exposure to equity factors in the turquoise blue color, the first color, and a bit of fixed income, which is our tips and commodities in the next couple of colors, and then as well as private real estate in the pale blue color. So within each of the asset categories that you see, the subcategories are represented when we break things down into a factor makeup. Next slide shows LACERA's active risk of about 1.4%. And we break that apart into allocation and selection. You can see in the bold numbers shown on the table, excuse me. The majority, as expected, is coming from selection. For allocation, we see changes there when there are shifts in our strategic asset allocation. So when the final targets went in July, we'll see that the allocation risk contribution will move even lower. The next slide shows a total fund broken out by geographical region, and this breaks apart both total risk and active risk by region. Both total risk has increased quarter over quarter across all regions shown. Monthly within the CIO report, we do have a breakdown by country, and so that's even more granular, so you'll always have that in-depth view of our geographic exposures. Lastly, for the risk portion, we show stress tests that are run on the total fund. The top 10 worst case scenarios, historical scenarios are shown for LACERA. The worst historical scenario was the GFC, or global financial crisis, back in 2007 to 2009. The GFC makes up the top 3 worst case scenarios. So portfolio and benchmark estimated losses are shown at the bottom of the table, and they're also charted in the graph at the top. And in 8 out of 10 of these scenarios, or the majority, LACERA would have less loss than our policy benchmark and would fare better than the benchmark. And at this time, I'll turn it over to Dale Johnson, and he's going to go over our climate portion.
Good afternoon, Chair and trustees. So this slide provides a snapshot of our approach to addressing ESG factors and climate exposures and the high-level metrics utilized in evaluating LACERA's ESG and climate profile. As trustees are aware, we've been using third-party ESG data and analytics to monitor the public market managers and LACERA's portfolio on certain ESG profiles where the data is available. The charts in the middle of the slide are an example of how we are using the data where available again to gain insight into the ESG and climate profiles of our portfolios relative to their benchmark and to similar mandates. This analysis provides two primary insights. First, we can identify concentrated exposures, areas of potential risk, and opportunities into the portfolio at various levels, such as the functional asset class or individual portfolios for assessing the fund's overall ESG and climate profile. For example, in the first table, you can see here that their overall global equities portfolio is less carbon intensive than its benchmark, with the carbon intensity of 164.5 compared to 173.1 metric tons of carbon emissions per dollar of sales for the benchmark. In the second table, you can see that a couple of mandates in our risk reduction and mitigation program, functional asset class, have fairly different profiles relative to each other for a very similar strategy, but interestingly, they have a higher carbon intensity than the global equity portfolio. Second, the data and analytics provide a quantitative profile of our external managers' approach to integrating ESG and climate factors in their investment process, which supplements our qualitative assessments of how managers are identifying and integrating ESG factors as presented in the ESG score on the manager scorecard. For example, manager 1 in the second table happens to be rated a 4 on a manager scorecard, reflecting an advanced level of integration of ESG and climate factors into its investment approach. In another example, such as in the third table, we can see that the manager has a higher carbon intensity and climate value at risk, or CVAR, than its benchmark. A higher carbon intensity companies generally have higher value, potential value of loss of value due to policies that it would be enacted to reduce emissions to limit global temperature rise to 2 degrees. This analysis provides discussion points with our managers to understand that how they are integrating climate-related analysis into company valuation and the portfolio construction process. Currently, we can evaluate the climate profile of our public market investments and real estate portfolio and engage managers on how they are taking into consideration certain ESG factors as part of their portfolio construction. We are pursuing several approaches to expand our coverage of climate data for the private markets assets to provide a more comprehensive total fund view of climate risks and opportunities. We'd be happy to take any questions.
Thank you. Any questions? Comments? Hearing none, we move them forward. All the other reports are for information only. Those for staff review.
I don't think I have anything.
Items for future agenda items. For the order, roll call.
Mr. Knox.
Great conference. Shout out to the staff. John, incredible job. And also for the AV setup was really terrific for the first time of something of this magnitude. Thank you.
Thank you. Mr. Green.
Great conference. Thanks so much. I agree with the AV setup. It's Joe Kelly's like the great Oz up there on the screen, huh? Like 10 feet tall. Really appreciate Linda putting this all together, and John and the whole team. The planning started 8, 9 months ago. So I know there's a lot of moving parts that goes into it, and really appreciate it. When we were talking about the investment beliefs, I was smiling because I was thinking that was the focus the first time we talked as a board about investment beliefs. So it's amazing come full circle. We have such a great staff, investment team, not to mention a really great board that believes in these investment beliefs. And just we've come so far as LACERA. It just makes me really proud to be part of this team and the group that we have. Lots of gratitude to everybody. I'm hoping we could move back to being in person. We could do this more often. So just thanks everybody for your help.
Thank you, Mr. Kehoe.
Thank you. Agree. Great audiovisual setup. Me being remote, I was able to fully participate and watch everything, and this actually worked out really great from our end. So this hybrid format actually worked well. Once again, I apologize for not being able to be there. But once again, great topics, a lot of stuff, drinking from a fire hose. I definitely appreciate all the information that we were given and the topics. And I'm still depressed from yesterday. The presentations from yesterday were tough, but they were important for us to have as board. So appreciate all the work from everyone.
Thank you, Mr. Kehoe. Mr. Jones.
I'll echo the kudos to the staff. Realize like what a production that this is on from the stage and behind the stage. Also for all the presentation materials and things ahead of time. And for me, when I first joined the board, it was all via Zoom. And while I've run into a few people at conferences, I got a chance to meet a lot of people for the first time yesterday. And so I can appreciate now the full height and dimension of some of you all on the screen that I couldn't before. So so it was much more depth. And equally as important though, I just love being a part, being a public servant and being a part of a community of people who are really interested in preserving a benefit and protecting a benefit for people who are working very hard on behalf of a lot of people here in this community from that perspective. So just kudos again to the staff, and I appreciate the opportunity to fellowship with everyone. So.
Thank you. Mrs. Jones.
Thank you for the wonderful conference. I already complimented Linda on all the efforts that are obvious to the eye of how much work went on behind putting an event like this together. So thank you. I learned a lot. As the comments already been made, it was basically taking water out of a fire hydrant and trying to capture it all. There was a lot of great information. I also appreciated having LACERA staff be involved with this guest speakers as well. So I appreciated hearing comments from both sides. And so thank you to all the LACERA staff as well. And I'm already going to ask for apologies because I, like Mr. Jones, met everyone through Zoom. And so if I see you again, I probably will not remember your name. So I'm asking for apologies already so that when we meet again and I'll go, now tell me again, what was your name? But it was really good to meet everyone in person. And I feel like this is my first time in school when, you know, you meet all of your classmates and then you try to remember what their names are the next day. You just can't remember. But it was so good to see everybody in person. And having the opportunity to be a part of this is actually for me pretty life-changing. I have, you know, taken just the thirst for investments and knowledge to like another level in my 20-year career. So I'm on fire for investments now. I even force my kids to listen to me about investments. So this has really been a great conference. So thank you, everyone. And all of your efforts are so appreciated. Thank you.
Thank you, Ms. Jones. Mr. Kelly.
Thank you very much, Ms. Jones. I'm Joe Kelly. How am I doing? I thought it was great. Thank you to the staff. It's really great to have staff present, and also to Makita as well, because they had really significant value. But I appreciate everything everyone did. Thank you.
Thank you, Mr. Kelly. Ms. Sanchez.
I also want to shout out to the staff. John, this was an exceptional lineup of not just topics, but also presenters. I think it was really, you really, took all that pandemic energy and put it into this moment. And so thank you for that. And, I've been lucky that and honored to have watched a lot of this process over the course of my tenure here. And I think it is wonderful that we are at a point where we are kind of, tweaking and considering and getting back to reflection things rather than inventing them from scratch. And so, we sit on the efforts of people well before me. And I think it's easy to forget that there was a lot of work that went into that first draft and second draft and third draft. And so I very much appreciate that. I also am very happy that we did this in a hybrid format because I think that it does create an incredible level of inclusion. When things come up, I pre-pandemic, I fought very hard just for a teleconferencing policy that now feels so antiquated and outdated. And that was 2019 when I got that approved. So it is amazing how different the world is in terms of being able to allow people to not just be a part and be a fly on the wall, but to be able to raise their hand, and in Joe's case, their virtual yellow hand, and be a real part of the conversation. And I just am amazed at how much the world has changed. And at LACERA, it has been incredible, and I think a very, very good thing. And so I thank, Santos Kryman, you came in kind of right at the beginning and had to live the experience of tumult and change and turmoil. And I think you've done an incredible job of stewarding our organization through that. And, John Grable and his team having to deal with the operational complexities of that. So, not that it's over and not that we're in any way done, but I just want to take a moment to reflect that this meeting really reflects how far we've come as an organization in the last 2 years. And I want to thank you all for your efforts there.
Thank you. John?
Thank you, Linda. Thank you, trustees, for all the positive feedback. What I'll say is the LACERA org chart says investment division. I like to say the investment team, and the team isn't possible without every member of the team. So thank you, teammates and colleagues. I think that all the feedback some of it may have been directed at me, but it's for everyone. So thank you. The other announcement that I'll make is sitting to my left, John Kim is a newly minted FA3 or investment officer. We just completed a search for an FA3 in portfolio analytics. Prior to John becoming an investment officer, he was a senior investment analyst in portfolio analytics. And this new position, John is very deserving of it. And LACERA, the investment team, and all our members will benefit by the increased responsibility and all the capabilities that John brings to the job.
It's just very nice to see everybody in person, meet some new folks. Great to be back.
Santos?
Which one? I'm joking. I just wanted to recognize John and the investment team. Kudos to you all. It's wonderful topics. Learned a great deal. I had the opportunity to be at the ALAD's fundraiser on Monday, and it was interesting because the questions that were being asked, when I was meeting some of our members that were retired as well as active members, the one thing that they always asked about was the investment portfolio. They didn't ask about their pensions. They didn't ask about, how do I retire? What do I need to do? They just really focused in on investments and, is the money going to be there when I retire? And they always tell me, make sure when I'm retired that you safeguard my funds. And I think that this particular conference demonstrates the depth of the investment team and the importance of the investment team. So we're going to start reaching out, going out and meeting our members where they want to be met. And so I just wanted to express to the investment team that your work does not go unnoticed. And it's an important function for every single member, quite frankly. And so my team on the pension side and my executive team are here to support you all with everything that you need in order to be continuously successful as we move forward and make sure that the fund continues to grow in the positive direction. And so I also wanted to recognize the trustees. I think that with your leadership and the vision that you all had 2016, 2017, I think has contributed to the growth of the fund. And now that we're talking about tweaking things and making things better and improving them is a testament, quite frankly, to your willingness to look at the materials and provide some insight and guidance to John, and of course, the input that the staff makes and that John makes and the decisions that he makes are quite important and reflects on the how well the fund is doing at this particular point in time. So I just want to say, John, thank you for your partnership, and thank the investment team for everything that you all do, and the trustees, quite frankly, for your stewardship and the guidance that you provided over the last few years. And I say that not only as a CEO of LACERA, but also a 33-year county employee. 29-year county employee. 3-year.
Thank you for that correction.
LACERA employee. That's important. Let that reflect the record, right? Thank you. So thank you all. So thank you.
Steve Rice. And Chair Santos.
Thank you. Great conference. Tremendous speakers. Like Ms. Jones said, I really appreciate the fact that the staff, many who I have not met until we got here, I've seen you on video, but it was wonderful to see the staff and the speakers, and it's very impressive to see how our staff, how knowledgeable our staff is. And that becomes evident when you interact with the speakers. That's something very precious to me, because yes, we are on the board, but you do the work. You are the ones who have to negotiate and